Ladies and gentlemen, thank you for coming today. We really appreciate it. It's a wonderful turnout we have for today's event. And a happy, enthusiastic, boisterous crowd. I love it. My name is Sean Neidorf. I'm the Senior Vice President for Research here at the Arizona Commerce Authority. And because Opportunity Zone started out as a data question, I'm also the person who oversees Opportunity Zone and Opportunity Fund efforts for the state of Arizona. Just to get a little bit of a show of hands, how many of you have either been to an event or watched a webinar or listened in on a webinar that we've done before? Oh, good, a good number of you. Well, it's nice to see you here in person because most of the time you're disembodied voices or emails. So this is much nicer. I want to just quickly go over the schedule for today. I'm going to give you a quick overview of Opportunity Zones. Most of you probably know this already, so I'm going to go quick. And then we're going to have a panel session with two excellent lawyers and an excellent accountant who are going to explain the nitty-gritty of the third and final round of guidance that we've gotten from Treasury, which came out just before Christmas. Then we're going to take a little break. Should any of you at any time need the restrooms, they're out the front door, to the suite and to your left. But that'll be a good time for a break. And then we will have a second session with panelists who are engaged in projects here in Arizona. And they're going to talk about the kinds of things they're working on, the opportunities they've found, the challenges they've run into, et cetera. So that is our charge for the day. Just get going here. See if this is going to cooperate. So I'm going to hit some of the real basics pretty quickly. An Opportunity Zone is a lower income census tract that's been designated as an opportunity zone by the U.S. Department of the Treasury. Please forgive the tautology there, but I have not been able to come up with a better description than that at the most basic level. Opportunity zones are part of the 2017 tax overhaul that some of you may remember from around Christmas that year. And in early 18, governors got to nominate a quarter of the tracts in their states that met the low income criteria for opportunity zones. Treasury then approved those tracts. Those who invest capital gains in long-term investments in opportunity zones can qualify for significant tax benefits. That is essentially the 50-second sales pitch, or the 50-cent sales pitch, if you will, for opportunity zones. So these were the criteria to qualify to be a zone, and I refer to this as the 20/80 rule. Either a census tract had to have a 20% poverty rate or a median family income of no more than 80% of the state or metro area's median, whichever was higher. Now, up to 5% of a state's opportunity zones could be slightly better off than that if they were adjacent to a tract that qualified that was also being nominated. These are called contiguous tracts. I sometimes refer to them as the buddy pass way to fly opportunity zone airlines. They were probably the single most confusing thing to most people on the selection process. I will point out, because this is important, that contiguous tracts could be up to 5% of the total 25% we were allotted. So in our case, 9 out of 168 was the max. It was not on top of the 168 we got. And what that means is that we were going to hold those to a really high standard because they were going to otherwise, they were going to have to come out of the height of tracts that qualified. So we wanted them to be really worthwhile. Now, it's worth noting that we were asked to use the 2011 to 2015 American Community Survey data from Census, which to some people feels a little overripe. I'll point out that that's the data most people were using at that time for different types of analyses. It was commonly known. The 2012 to 16 came out just as this was happening, so they gave us the option. But when people ask why we use that data, that's why. So I'm going to very quickly talk about census tracts. Census tracts, as it says here, are small, relatively permanent statistical subdivisions of a county. The idea is to have 4,000 inhabitants in a contiguous area. The smallest ones in the country are 1,200 people. The largest are 8,000. The variance is really a function of density. Census tracts, importantly, do not cross county or state lines, but they couldn't care less about your city boundaries or tribal boundaries. They just wash right over them. So again, I want to just point out that residential density really, really affects the shape of tracts. And you can see that here, because when I show this map in rural areas, the first question is, why are so many of the tracts in urban areas? When I show this map in urban areas, the first question is, why is so much of the opportunity zone land in rural? And the answer is the same to both of those questions. The unit of concern here is the tract. And in an urban area, you can get about 4,000 people in a pretty dense little square rectangle. In a rural area, they're going to look like large modern art shapes. So just to give you a sense of perspective, in the state of Arizona, we have just over 1,500 tracts. 671 met those 2080 criteria, and we got to choose 168 of them to be opportunity zones. Just to point out, we have urban, suburban, and rural zones. We've got tribal zones. And as we like to say, we've got a zone for every project and a community in need of meaningful investment in every zone. Every county has at least one. As I mentioned, we were permitted up to 9 of those contiguous tracts that didn't quite meet the standards of the 2080 rule. We ended up only submitting 8 of those, all of which were approved by Treasury. And we have opportunity zones on both their own map and on the Arizona Assets map. How many of you have seen one or both of those? Okay, if you Google Arizona Opportunity Zones, you'll find a lot of stuff on our website, including that map. If you Google Arizona Assets map, you'll also find that. I don't want to spend a lot of time with this, but this is the process we went through. Hang on, I'm going to get a little water here. Sorry. That wasn't helpful. So as I mentioned, the state gets 25% of its qualifying tracts to be designated as opportunity zones. Governor Ducey asked Sandra Watson, our president and CEO, if ACA would handle the process of taking in input and making recommendations to him as to what tracts he should nominate. And Sandra's thinking was that we should be proportional. If the state gets 25% of its qualifying tracts, then we should reach out to jurisdictions and ask them to recommend up to 25% of their qualifying tracts. In Maricopa and Pima counties, where we have larger communities, any incorporated community of 10,000 or more people was asked to make its own recommendations. Elsewhere, we asked the counties to make recommendations, or tribes if they had tracts centered on their land. For the rural and smaller towns in Maricopa and Pima County, the counties spoke for them. Now, part of this is because, as I mentioned, tracts wash right over city boundaries. In some of our rural communities, we have tracts that pass through as many as 8 communities. So it would be really difficult to figure out whose tract that was. Now, because they do wash over urban area boundaries, the way we did this was called a Centroid Approach. So any tract that qualified, we looked at where the literal mathematical center of it was, and wherever that was, that jurisdiction, we counted that as their tract. And when we did the math of here's your total tracts divided by 4, that's how we did it. Didn't mean they had to pick the ones that we identified as, you know, being on their borders, but that's how we did the math. We hewed to that pretty closely. We did have to make some adjustments, in part because we rounded up. So if a community was entitled to 7.5 tracts, we gave them 8. But then, of course, we had to get it back down, and we also had to get it down to incorporate the 8 contiguous tracts. So we didn't, you know, just do it on our own. We got a lot of local input, and you can see that in where the tracts have turned up. So all of that was done in early 18. Our tracts were certified in early 18, and we've been focused ever since on trying to maximize the utility. So the way this works is that U.S. tax code provides capital gains benefits meant to encourage investors to sell their passively held investments, reinvest the resulting capital gains in long-term investments in property or businesses in these opportunity zones. Note that it does require the use of an intermediary vehicle called an opportunity fund. I get a lot of calls from people who've rushed out and bought property in the zone without a fund. Please encourage people not to do that, and please don't do it yourself, because you won't get all the good tax goodies out of that. Now, I will point out that this is actually a bipartisan idea that's floated around for a while. Senators Cory Booker and Tim Scott have been the big proponents of this. So you see here what the actual tax benefits are. Let's say you sold a property and your resulting capital gain was $10 million, and you in turn turned around and put that money, that $10 million gain, capital gain, into an opportunity fund. First of all, you would not pay taxes on that gain until several years from now. It would come due on December 31st of 2026, and you would pay it with your spring taxes in 27. In addition to that, if you get your money into the fund by the end of 2021 and leave it in there until 2026, you will get a 10% reduction in that tax that you pay. So instead of paying on your $10 million gain, you'll pay on a $9 million gain. Now, you'll see I've grayed out here. You could have gotten a 15% reduction, but that would have required that you'd invested by last year. If you got your money into a fund by last year and hold it through 2026, you'll pay on $8.5 million instead of $10 million. But that's kind of the smaller piece of it. The big piece of it is the money that you've put into the fund. When you exit 10 or more years later, you can basically do a fancy thing called electing to raise your basis to fair market value, which means you will not have a capital gains tax bill for that second investment. State tax benefits depend on the state. Arizona is what they call a conforming state, so that makes it pretty easy to both be someone who lives here and invests here in opportunity zones. Some states don't, and that makes it a little more complicated. I want to point out that some states are adding extra incentives to encourage people to invest in opportunity zones. We have not done that, but that's because every one of the incentives we have that apply statewide apply in opportunity zones, and that's the vast, vast majority of what we have. So we would strongly encourage you to look at those because they can be coupled with opportunity zones. So just to give you a quick overview on the funds themselves, they have to be organized as a corporation or a partnership. LLCs are acceptable. They may be organized to make single investments or in a single project, or to do multiple projects and investments. They have to be certified by Treasury, but that's a pretty simple self-certification process of filling out a form that you file with your taxes. Funds are required to have 90% of their assets in qualified opportunity zone property, and they get judged twice a year on this, so that's an important thing for them to keep in mind. There is a penalty if they fail to meet that. Part of the point of this bill is to have some timing elements to encourage investors to move quickly at getting their money into the funds, and to encourage the funds to move quickly to move the money into investments. Hold on a second here. And you have three options if you're an opportunity fund and what you can invest in: business stock, business partnership, interest, or business property. Business property can be real estate, but it can also be equipment, for example. Purchases have to be made for cash, and stock must be original issue, so you can't buy it on a secondary market. And opportunity zones must not invest in what are referred to as sin businesses. I'm not going to spend too much time with this here, but this is a compare and contrast between opportunity zones or opportunity fund investments and 1031s. And you can see that there's some similarities in that you have to move pretty quickly within about 180 days of exiting an investment. But a key difference is where in a 1031 exchange, an investor would reinvest principal and capital gain. The tax benefits only accrue to the capital gain in the opportunity fund investment. You also have the option to put some or all of your opportunity fund investment, or excuse me, your capital gain into the opportunity fund, whereas you have to roll everything with your 1031. We're going to make this available, so I would be happy to tell you guys, look, I don't want to spend too much time with it, but I wanted to let you know it's there. We're going to put this up on our website. Excuse me. To give you some zone and fund context, the opportunity zones and funds, this is essentially a tax provision. It's not a program in the way that people tend to think of programs. The dollars invested are not capped, but they must be capital gains that get the tax benefits, and they have to be invested within a limited period of time. These aren't government dollars except to the extent of the tax deduction. No government application or pre-investment review exists for an opportunity zone project. This seems to surprise people who keep calling me and asking me where they can apply. There's no government review, rating, or licensure of opportunity funds beyond the self-certification. There's no statutory requirement that investments in the zones be aligned with community desires or that investors engage communities in the development process. Doesn't mean you can't, but I do sometimes have to point out to people that that's not in there. There's also no public reporting requirements at this point, although the IRS Form 8996 that funds use to report first that they're getting going and then to report their annual returns, that's been revised to have some reporting requirements on a fund's investments. Now, the Opportunity Zone statute is short, but it's really quite complex. This is the kind of thing that it takes Treasury often years to sort through and make rules for. But that's a little bit difficult in this case, since to make any benefit out of it, you need to invest by 2026. So there's a lot of Treasury process that we've all been through. We got our first substantial round of guidance from Treasury in October of 18, and that gave us some guidance on setting up funds, how IRS lets people, or how people let IRS know that they're not just running off, that yes, indeed, they will pay their taxes after the deferral. Clarified that only capital gains would receive the opportunity fund related benefits, not ordinary gains. And it established a working capital safe harbor for companies developing projects with opportunity fund support. This was important because in the same way that investors had 180 days to get their money into a fund, the fund had to show it was deploying 90% of its capital every 6 months. And that's a really hard way to do responsible investing because you have to shovel a lot of money very quickly. So the safe harbor was meant to make that easier, and that's gotten more expansion and clarification in subsequent guidance. Also made rehab projects more desirable, if still somewhat challenging, and it made investing in businesses that are largely but not wholly in opportunity zones feasible. We got another round of guidance in April of 19. It delved into how to invest in operating businesses, including clarifying guidance that had come out in October. It explained how to invest in opportunity funds on rented property, which is also touched on in the final guidance. And this is a big deal here in Arizona, where a lot of our land is state or federal or tribal. So the idea that you can actually do opportunity zone projects on rented land is a big deal for us. Also discuss tax implications of interim gains and rules for reinvestment, which comes up when a fund holds an investment for less than 10 years. We got a third and final round of Treasury guidance in mid-December of last year, and it will take effect mid-next month. I don't want to get into that too much because that's what our next panel is going to do, so stay tuned. I think I'm going to try to plow through this quickly because we only have a little bit more time. If you're going to buy stock or partnership interest in an opportunity zone business, it has to be obtained at original issue for cash. The business must be a qualified opportunity zone business when the stock was issued or the partnership interest was acquired, or it has to be organized to be one. And during substantially all of the fund's holding period for the stock or partnership interest, the business must qualify as an opportunity zone business. And if that's clear as mud, don't worry. Here are some of the criteria. Trade or business in which substantially all of the tangible property owned or leased by the taxpayer is qualified opportunity zone property, also a little tautological. 50% or more of the total gross income is derived from active conduct of such a business, and a substantial portion of the intangible property of such entity is used in the active conduct of any such business, and less than 5% of its assets are invested in non-qualified financial property. So it can't essentially be a holding company. It also cannot be, and this is where I really want the disco ball to start turning when I read this list, cannot be a golf course, country club, massage parlor, hot tub facility, suntan facility, liquor store, racetrack, or other facility used for gambling. This is the sin business exclusion. Now, the final guidance did make a slight exception to that we'll talk about during the panel. So, opportunity zone business criteria, it has to be a trade or business in which substantially all of the tangible property owned or leased by the taxpayer is qualified opportunity zone property. In October of 18, they told us that substantially all means 70% for this purpose. So that means an opportunity fund that has to have 90% of its investment capital in qualified opportunity zone assets can actually have just 63% of its money in such assets if it invests in businesses rather than directly in other holdings. 70% rule also makes it easier, though still not easy, to invest in an existing business that has been around for a while. I will say that there are questions about the impact of final guidance on that matter. So if you're looking at investing in an existing business or you're an existing business looking for funding, this is something to pay attention to. So we're also talking about a trade or business in which half or more of the total gross income is derived from active conduct of such a business. Now, the guidance that came out in October of 18 said that it should be half of the total gross income derived from active conduct in the zone. That caused some serious conniption fits because no one knew quite how to meet that standard. So Treasury's April 19 guidance gave a range of ways to comply with that. It could be based on the share of service hours performed in the zone, or the share of cost of services provided in the zone, or tangible business and management or operations in the zone are needed to generate 50% or more of the business's gross income, which, correct me if I'm wrong, lawyers, but that seems like the easiest one to meet, or a facts and circumstances test. We're also talking about a trade or business in which a substantial portion of the intangible property of such entity is used in the active conduct of any such business. The April 19 guidance set substantial for this purpose at 40%, but didn't say how to define 40%. They did jump back into this in the third round of guidance, so you'll hear more about that in the next panel. Qualified opportunity zone business, property. So if you're a fund and you want to invest in this, it has to be acquired by purchase after December 31st of 17. The original use starts with the fund, or the fund substantially improves the property. Property is substantially improved if during any 30-month period following acquisition of such property, there are additions to basis that equal the adjusted basis as of the beginning of such 30-month period, which is honestly a pretty gobbledygook way of saying whatever you spent to acquire it, you're going to have to spend fixing it up. During substantially all of the opportunity fund's holding period, substantially all of the use of the property was in a qualified opportunity zone. They defined that as 70% in October. But that middle piece was still pretty tricky for people. So what is this substantial improvement? If it's not original use, what is substantial improvement? And again, we talked about that you have to essentially double your money that you've spent. Whatever you spent acquiring it, you have to spend fixing it up. But that makes it very hard to do rehab projects. So in October of 18, guidance came out that said the fund may distinguish between what it paid for the structures on the land and what it paid for the land. And the fund must spend only the equivalent of the value of the buildings on substantial improvement. Still not a super easy standard to meet, but an actual possible standard to meet. The other dollar for dollar felt pretty difficult to folks. Now, original use is used but not defined in the statute. And in October of 18, their guidance said land could never have original use, which also caused some pretty serious conniption fits. The April 19 guidance said, well, original use for tangible property, including land, begins when the property is placed in service for purposes of depreciation or amortization. So you actually had a starting point, which was helpful. Also, buildings that have been vacant for several years may be repurposed under original use rules, which are less stringent than substantial improvement. And there was some disagreement as to what the right number of years that it should have to be vacant. And they started out with 5, but in this most recent round of guidance, they cut it down to 3. So what about undeveloped land? Undeveloped land doesn't need to be substantially improved, but according to the April 19 guidance, there's a big warning about buying with the intent not to improve the land by more than an insubstantial amount within 30 months of purchase. Also, the land must be used in a trade or business. IRS is not keen on land speculation or land banking here, and they get into this a little bit more in the anti-abuse practices that or provisions that they talk about in the last round of guidance that, again, we'll hit in the next session. So there's a bit of a time crunch issue here. Investors generally have 180 days from when they realize their capital gains to put them in the funds, and the funds have to have 90% of their money in acceptable opportunities on assets, and they get judged every 6 months. So these time pressures made investment difficult, made planning difficult, and the guidance helped with some of that. I'm not going to spend too much time with this, but I mentioned that there was a safe harbor, which meant that funds would not be judged for having money in hand if it had been turned over to a company with a plan for development and a schedule, and that they actually adhered to it. There's been some additional work on that made it easier to use that for operating businesses. There were questions about, can you do overlapping 31-month harbors, so you have maybe one for the underground work, one for the above ground work. And in December of 19, they took this up again to say just how far can you push that and what can you do. As we said, opportunity zones are meant to move quickly, and the testing was part of what was tricky. If you are a fund on a calendar year and someone came to you on June 28th with a large deposit, and you were going to have the tax man show up on June 30th and be upset that you hadn't deployed 90% of your capital, that was a real nightmare scenario. So what they did was exclude money that you had received in the prior 6 months from that judgment. Okay. As I mentioned, leased property is permitted. You can operate on that, and leased tangible property may count as qualified opportunity zone business property for purposes of the 90% asset test at the fund level and the 70% asset test at the business level. So there are rules about it starting after December 31st of 17 and being market rate, and well, we can just skip that. So there was some more clarity that made leased property more desirable to work with in the 2019 April guidance that talked about no original use requirement for leased tangible property and no substantial improvement requirement either, and that the lesser can be related to the opportunity fund or the opportunity zone business, but there are restrictions that generate pros and cons on that. There's some additional material that came out in the final round that we'll talk about. So one of the things they also clarified was that owning and managing rental real estate qualifies as operating or trade or business, which is good. Triple net leases generally are problematic, although they softened that just a little bit in the final guidance. And there's also the possibility that if a property straddles an opportunity zone, it's possible to treat the whole thing as an opportunity zone property. There's some coverage of that in the April guidance and again in December. That's come up quite often. We get that question, so we usually send people off to their tax and accounting professionals for that, but it is a possible thing to do. The April 19 guidance clarified that opportunity funds have 12 months to reinvest interim gains without the proceeds counted as bad asset under the 90% test, but there's going to be a tax hit on the investors, which is a little bit of a challenge. It means you really do need to hold the investments for 10 years to get the benefits. I'm going to skip a little bit of that for some time. I do want to point out to you that how many of you have seen our Arizona Opportunity Zones Network? Oh, just a handful. This is a tool we've built. It's an interactive tool to let folks in the Opportunity Zones community work with one another without us having to get in the middle. So this is a place that you can look for a lawyer, an accountant, or another professional. It's a place that you can look for a fund that is raising money or deploying capital. It's also a place that you can look for an investment opportunity. Conversely, if you're someone who has an opportunity that you want people to know about, you can post it here. Last time I looked, we had 118 opportunities posted on there from throughout the state. So before we open it up for questions, and I'm going to try to keep this brief because we're running just a little bit behind, I want to ask, excuse me, I'm sorry, I'm just losing my voice here today. Jim, are you here? I saw you before, Jim Pipper. You want to stand up and tell folks what you've got going on? Because he's got another event he'd like to invite you to. All right, thank you for that. And at this time, I'd ask Ben, Mark, and Brett if you guys can come up and get settled, but I'll ask, are there any questions from the audience that would go to me as opposed to our legal and accounting experts? Now you're just waiting for the big guns. That's okay. Oh, yes, sir. The zones themselves are in statute for 10 years, but the investments can go. That's what I was going to say. You have to get your money in by 2026, and then what you're saying, September? Turn your mic on, because it might be easier for you to answer this.
You can have, is it working now? You can have a gain in 2026, and the way the rules work now, you can have up to, I think it's either September 10th or 11th of 2027 to invest in the fund. You don't have to sell anything in the fund until through 2047. So there's plenty of runway.
Anybody else before we shift gears a little bit? Okay. Make sure your mic is on. Do you all have your mics on? I'm just checking. Ben, do you have yours on? Okay. So our first panel today is going to focus on the final regulations review, looking at the impact on opportunity zones and funds, how the rules affect investment strategies, and what to expect, good Lord today, in the future. So I want to ask our panelists to introduce themselves. Ben, could you start?
Sure. I'm a tax principal with Clifton Larson Allen. I work in our real estate industry group and focus on helping owners, sponsors, developers in the real estate space.
My name is Mark Schultz. I'm a tax partner at Snell and Wilmer. I co-chair our Opportunity Zones practice, and I chair our tax credit financing practice, which is really how I got involved in the Opportunity Zone spaces. The new market tax credit is really kind of the predecessor. A lot of the rules are similar in the OZ space, so that's what drew me to the OZ incentive.
Hi, I'm Brett Siglin. I'm a partner at Jennings, Strauss & Salmon, downtown Phoenix. And I also have a background over the years in the tax credit arena, kind of tax advantage real estate transactions. And I'm in the corporate and real estate group at Jennings.
Well, thank you. Mark, I'm going to ask you if you would kick us off by talking about how to handle investments that involve property acquired before 2018. And if you could maybe also work in there, the working capital safe harbor.
Sure. Thank you, Sean. Just to start off, the key thing is having opportunity zone business property. And so that is defined as tangible property acquired from an unrelated person after 2017. Okay. So the big issue has always been, okay, well, I have property that's pre-2018 property. How do I make this work? Okay. So the rules say that you can have up to 30% bad property, non-opportunity zone business property. So if you have pre-2018 property, that can be in your bad bucket where you get 30% of it. Question is then you have to have 70% of good property, right? So if I have, what is bad property? Well, if it's not acquired by purchase, if it's a joint venture where someone contributes that property to a real estate joint venture, I've got bad property. If I buy that property from a related person, I have bad property. So let's just say I have a real estate joint venture and someone, the property's worth $10 million. So based on those numbers, I need to have $25 million of good property. Well, I'm building something on top of the real estate, so arguably I will have, let's just say it's a $100 million project, I will have plenty of good property. The question that we have right now, the conventional wisdom has always been that the cash I have, as long as I'm going to spend it on good property, I have what's called a written plan that's in place when I contribute the cash that says I'm going to spend it on good property. As long as I do that within the 31-month safe harbor period, I'm okay. The regs that came out, and most practitioners thought that was the case. The regs that came out, one of the, you get to see sausage made in Washington. You've got two stories. You've got the preamble story and then the actual reg story. The preamble says, yes, that's good property. The cash is good property. The body of the regs, one interpretation that's running around the country is that it says that cash is not good property until it's spent. So it's one of the issues we have right now is I have pre-2018 property. It's bad property. I have in my example, 25 million of cash on hand, and I'm going through these testing dates, and I want to treat the cash as good property, but the way one interpretation, again, that's running around the country, and everybody's asking the IRS about this, is cash is not good property until spent, which means how fast can you construct and convert that cash into good property. So it's one of the issues out there. It also affects operating businesses that are already in a zone, right? It's been these operating businesses have been in the zone, for a while. A lot of the property that they have is bad property, and now they want to do an expansion. And the problem they have is they have this cash infusion, but they can't spend the cash fast enough. So one workaround that people are doing is, I said that, a property has to be acquired by purchase. There is the ability in the April 2018 regs, they allow a related party lease. Like that leasehold interest in that property is good property, even if it's from a related party. And so what a lot of folks are doing is they're reconstructing these things and saying, okay, well, we'll do a land lease. That leasehold interest is good property. Everything we build on it is good property. And as soon as we've converted, in our example, we've converted enough cash to good property, which would be 25 million, then you can exercise an option to go buy the fee simple land. And now I've got, 25 million of good property. I've got $10 million in my option of bad property, but I meet the 70-30 test. The one key thing is that option has to be exercised for fair market value at the time of exercise, so that you run the risk of that 10 million going up in value to 15 million, and then 25 million is not enough. So it's one of those issues out there. The IRS is getting hit from all sides on from everyone, including the Real Estate Roundtable, which is a group of some very high-end real estate professionals around the country. And so I think they're going to give on this issue, but it's one of those issues that are that's sitting out there right now.
Actually,
Would you like to?
yeah, just to add some color to that, I mean, historically, when the statute came out at the end of 2017, and we had absolutely no guidance at the time, it was like an 8-page statute before we had the 500+ pages of regs. One of the first things Treasury did in 2018 is they came up with this working capital safe harbor that Mark alluded to. And, logic would suggest that the whole point of that was to give developers and sponsors and anyone who's actually going to acquire and improve land time to do so, because without that safe harbor, ultimately have, like less than 6 months to develop a project, which is almost impossible for anybody. And I think the ground lease structure is a great vehicle, but in practicality, very few people want to do that. It's hard to get financing. So we're hopeful that, coming out in the next few months, Treasury is going to get wind of that and go back to the original plan, which was to allow developers to use this working capital safe harbor and buy them 31 months to utilize the funds and put it to work.
Yeah, I mean,
I was just going to add, not to steal the show, but I was going to say one more thing about the way the statute and the proposed regs and the final regs came out, because we actually have clients that find themselves in that spot where they are improving property that they already owned under a structure that wouldn't work under the final regulations. So the good news is that there are positions that you can take because of the way the statute and the proposed regs and the final regs were issued in terms of your ability to rely on those as they came out. So just because Treasury came out in December and said, here's a set of final regs that are interpreted the way Mark has described them, if you were operating in good faith under the proposed regs or the statute without the regs and reached a conclusion, you still have an ability to rely on those, and you don't have to follow the final regs. So there's hope for people who were early in the game that's decided to take action.
yeah, I mean, Treasury, their concern is that things are not going to get done, right? And so my argument that we just put in a white paper is that, if you have to have 25 million of cash on hand, I mean, let's just say your project is 40 or 50 million, you're actually over-capitalizing the project by having to have 25 million of cash on hand. And the fact that you have to have, if that's the rule, you got to have this, I call it the show me the money test. The chances of your project not getting done diminish significantly, right? Because a lot of lenders aren't going to loan unless you have the cash. And you're saying, I'm bringing the cash to the table because I've got to meet these tests. So from a policy standpoint, it seems like this is the right approach. And so my guess is there was some confusion. My understanding is the folks that wrote the preamble were not the same folks that wrote the regs. And so there's this disconnect. And so it shouldn't be the taxpayer's fault that,
Can I jump in? Because I want to move us along because we only have so long. But working capital safe harbor, this was an idea that came up early. Then there was a question, can you go beyond the 31 months? How many 31-month periods can you have before it becomes abusive? And this became a topic that was addressed in the final regs. Brett, do you want to maybe talk about that a little bit and others maybe join in?
Sure, and this was most favorable, so it's another reason why it's kind of hard to understand why they wouldn't want to respect the first safe harbor. But essentially, what they're saying is you can have up to 62 months, and you might have multiple 31-month working capital safe harbors that are triggered with each capital investment into the fund. So it's just another way to give sponsors and developers who might be raising money over a period of, say, 12 to 24 or even 36 months, more time to take advantage of the safe harbor, put the funds to use. And ideally, they use those funds first. You can use those funds to take down land. You can use it to pay architects. You can use it to get entitlements. So, if it's a land development, it's not hard to put that money to work. And as Mark alluded to, I mean, if you're well-funded, that's a nice problem to have.
Yeah, and just on that working capital safe harbor, so one of the requirements is you have to be in a trade or business. And so the question that I get is, when do I have to finish my project? You know, and that was always out there, like, how long can my construction go? And so the idea, you have to be in a trade or business, and a trade or business means you're doing an activity on a regular or continuous basis for the production of income, right? And the act of development is not a trade or business, because that's not gonna, it's the act of owning the asset and leasing it, that's the trade or business. So the idea is, how long do you have to get into that trade or business? What they did is, they said, okay, you got this, you put the QOF puts its initial infusion into those EB, you got 31 months. Then if you put a second infusion in, you get another 31 months, never to exceed 62 months from the first infusion until that last period on that last infusion. So you're really expanding this time period to get into your trade or business. So arguably you have 62 months, you can stage it so you can get 62 months to get your project completed and operational.
Okay, I want to move us on to a different issue, and that's asset aggregation. As we talked about, there's a rule about making a substantial improvement to a property, and the question was, well, what if there are multiple buildings on a property, and one is fairly new and doesn't need much, and another building is pretty dilapidated and needs a lot of work, and scenarios like that, and the question of, could you aggregate the improvements you did over the entirety of that property, or even over the entirety of a fund, or did it have to be each building by each building and each element by each element? And the question of how granular the asset improvement measurement was going to be, and that was addressed in final regs. And Ben, I was hoping you would kick us off on that.
Sure. So when the proposed regs came out, as Sean commented, what they did was they provided that the 70% substantial improvement requirement, which applies to an asset that has been used previously, okay? So we're talking about a building typically that had been used previous to this. You had to substantially improve it. And the issue that we have is sometimes you'll see these are projects where they go in and they buy a number of different assets because there are multiple buildings or property types out there. And the question was, how do you measure aggregation in that 70% test? Do you get to measure it? Do you have to measure it on a building by building basis? Or can you aggregate them and treat them as if they were one property? Well, the proposed regs made it pretty clear that it was an asset by asset test, which was going to really throw out a bunch of projects because not every building needs to be substantially improved, right? And so the good news was they saw through the comments that were provided, and they provided a means by which we can aggregate. So, and they had two ways you can do it. You can aggregate the 2 or more buildings that are located in one tract, or if they're contiguous tracts, you can do the same thing. So that really will help, I think, development projects so that they can, spend the money buying the property they want and improve the property that they want. They're still going to have to meet the requirement to substantially improve in the aggregate. So they're still going to have to make substantial investments in improvement.
Okay. Okay. Unless anybody has something dire.
Well, yeah, I mean, they give us a good example in the regs. They say this: you buy this hotel building, right? And the idea is that I buy it for 10 million. I'm only going to put a few million of actual improvements in the building. And so that's not going to get me to the substantial improvement test because I need to spend more than, if I bought it for 10, I need to spend more than 10. I'm only spending 3, but then I'm going to be buying linens and equipment and all this other stuff. And they're basically saying that other equipment, even though it's not technically an improvement on the building, these are other assets. And because it increases the functionability of the business, the hotel, I get to include those assets in meeting my $10 million substantial improvement requirement.
One other point I just want to touch on that sort of predates all this is prior to the first set of regs that we got in October of 2018, there was a lot of concern in the industry that, this is really a land development program and it's really hard to improve buildings. So one of the things that happened after a lot of lobbying, especially on the coast, is that they came out with this ruling in October of 2018 that said, if you've got an existing building that you're going to acquire, you don't actually, let's say it's a $10 million building, that's the fair market value of it, but maybe half the value is in the land and half is in the structure. You don't have to do 10 million of improvements. You only have to do 5 million to actually improve on the building. So this is just one more, tool, if you will, if you're, operating a fund that wants to acquire existing buildings that are in maybe dilapidated low-income communities. This is sort of the idea behind the incentives. They want to encourage this sort of thing.
And because I know you're going to get to it, so when we're talking about these buildings that were used, so one of the questions that came up in the statute was, well, what if the building hasn't been used for a while, right? Because the test was original use. Well, original use might have happened a long, long time ago, and it might have been sitting vacant for a long time, right? And the first round of proposed regs, they said, look, we're going to define what original use means. We're going to say that if the building hasn't been used for 5 years, it's been vacant for 5 years, then it qualifies as being original use, which means you didn't have to double the basis of the building in terms of the cost of improvement, which helped make a project more viable. So that was where we started. There were a lot of comments with respect to 5 years being too long. And so they listened to those comments and they moved in the direction of being taxpayer favorable. And they essentially said that vacant is going to be defined as if it's been vacant 12 months prior to the publishing of the tract in the respective map, that's going to qualify, or 3 years from that date of publication, if it's been vacant, it's going to be treated as vacant. So they gave us essentially a 12-month and a 36-month way of defining what vacant means for purposes of that substantial improvement test, which again is going to help get projects done because it makes it a little bit more affordable.
One more thing to add to that they said in the same rule was that it doesn't even have to be 100% vacant. It could be 80% vacant. So if you've got a building that has some operation, as long as up to, less than 20% of it's being used, it can still qualify as a vacant building. So it just goes to show how much they're trying to encourage that sort of thing.
Brett, I want to stay with you for a minute and ask if you can talk a little bit about the requirements for being in an active trade or business and loop that in with what the implications are on triple net leases.
Sure. So I think, Sean, you touched on this earlier. So one of the requirements to be a qualified opportunity zone business, there's 5 different tests, and one of them is this gross income test, and that test is essentially that at least 50% of the gross income from the business has to be derived in the zone, so to speak. And she talked about there's 3 or 4 different ways you can satisfy that. So one of those things is you have to be in the active conduct of a trade or business in the zone. And I think Mark touched on this earlier, that it really goes to what your business is of the fund. And so one of the issues that's come up, it's been quite controversial really from the beginning, is that there's certainly a lot of people out there that are triple net leasing property. So if I've got a fund and I own a handful of these qualified opportunity zone businesses and I want to invest in commercial real estate, buildings throughout the country, I'm probably going to want to be talking to, some tenants out there that are going to be accustomed to this triple net lease concept. And so from the beginning, Treasury's been quite adamant that triple net leases do not constitute an active conduct of a trade or business. And so we got 2 examples in the latest final regs that help, but not really. So they give one example where if you've got, say, like a CVS or a Walgreens in a building and single tenant, obviously they're running the show there. I just own the building. I've got very little activity. That's clearly not going to qualify as an active conduct of a trade or business. It's not going to work as an opportunity zone deal. And, by the way, there's a lot of people out there that think you can just sell an existing CVS that happens to be in an opportunity zone and call it a done day. But, there's this whole substantial improvement aspect to it that you have to satisfy or make it original use. So the other example that Treasury gave in the final regs was interesting because basically they said, let's say you've got a 3-story building, we'll call it an office building, and maybe on 2 of those floors, I've got triple net tenants that are double net, or they're gross commercial lease tenants. And then on the retail floor, let's say I have a triple net lease. If you follow that example, that's, you know, sort of a safe harbor, if you will, that would probably work. But then there's this gray zone where, you know, where do you draw the line if, say, 1 out of 3 tenants is not triple net and the other 2 are? Or, you know, it's still unclear, and maybe Mark, you have thoughts on this, like how do you distinguish a triple net lease from any other commercial lease?
Yeah, I mean, I've had a bunch of discussions with Treasury on this, and you know what their concern is, and what I took away from my conversations with Treasury is that, you know, with the triple net lease, you know, what is it? Taxes, insurance, and what am I missing?
Maintenance,
right?
or management. Yeah.
And so they're concerned. They want you to do something on the property. They want you to have an obligation on the property. And in those examples, they talk about the word meaningful managerial and operational control of the building, right? And so so what we do is we always build in the maintenance obligations on the landlord. The key thing is in those examples, which is concerning, is they talk about the actual landlord having employees on the site. And so, you know, the big issue is, can you really delegate that authority to a third-party company? I think you can. I think that's the intention. I think contractually they want the landlord to have that maintenance, the managerial and operational control of the building. I mean, that's my takeaway, but, you know, it's subject to interpretation. So.
Yeah, we're on the tax return preparation side of all of this stuff, and this whole question of what substantial services are for a situation where you have a single asset that's being leased to a tenant under a typical triple net lease arrangement. The question of how do you get there? The services as part of tax reform has also addressed that topic. They, in a completely different setting, right, they've again gone back and said it's typically based on case law, historical case law, which comes back to the level of services that are being delivered associated with the property. They gave us a safe harbor in the qualified business income area that said 250 hours. If you can support that through contemporaneous evidence, then you qualify as providing substantial services. So I think you can engineer it, Mark, to your point of what you're doing inside of structuring the leases so that the landowner is responsible for providing significant services. And I think you have to be thoughtful about doing that, because if you don't, then you're going to fail, and you'll fail completely. Yeah. This is a sort of a big cliff issue.
I'm going to, just to keep us moving, I apologize, we've got a lot to hit. Mark, can you talk about exits? Because we've all been talking about how to get in, and we keep talking about 10 years, but the question is, okay, now 10 years are up. What do the exits look like? How do you get out of the investments? How do you get out of the fund?
Sure.
What's that going to look like? And can you roll into interim gains from that?
Sure. So you know, you got these 3 benefits, right? One is you get to defer your capital gain. 2, you get a 10% reduction of the capital gain when it is taxable, which is in 2026, and you pay your tax in 2027. The last benefit is, you know, to the extent you invest in the fund, and after you've held for 10 years, your asset has, your investment has appreciated. Now you exit, and the idea is that is tax-free, that exit. You know, so there's a day of reckoning on your original gain, but everything above that is tax-free as long as you hold for 10 years. So when this first came out, the only exit possibility in the statute was you had to sell your interest in the fund. Okay, so even though the fund's investing in an opportunity zone business which owns an asset, you had to sell your interest in the fund. And then in the regulations, they gave us a second exit option, and that is for the fund to sell its interest in the opportunity zone business. And so everybody went, and that's only if the fund is a partnership, right? I mean, so it's, you know, a lot of people ask you set up a C corporation or partnership fund. The partnership gives you way more flexibility. So I can sell my interest, the fund can sell its interest in the opportunity zone business, and that income gets allocated. The LLC or limited partnership doesn't pay tax, just allocates that tax to the taxpayer, the investor. And so everybody asked Treasury, they said, listen, multi-asset funds, they need more flexibility on how to exit. So what they did in the final regs is they said, listen, if you have a partnership for a QOF, you have a partnership for an OZB, the OZB can sell an asset, and as long as you've hit the 10-year mark as a holder, then that gain that gets allocated to you get to exclude it, okay? Except for the sale of inventory. For some reason that is a problem, but everything else is okay. So that's real good flexibility, makes it very possible to do a multi-asset fund now. The question then is, well, what happens if you sell that asset before the 10-year mark, right? And the folks that created this incentive, EIG, Economic Innovation Group, they always thought that this would be used for VC startups. Most VCs don't want to hold for 10 years. So, 3 to 5 years out, the fund can sell an asset, reinvest the gains in a qualified asset, and boom, everything is fine. There's no tax to pay. The Treasury, when they looked at the legislative history behind this, noticed that in the legislative history, it does say that gains inside that 10-year period were taxable. And so they said, hey, we don't have the regulatory authority to fix this through regs. You got to change it through Congress, and which means you got to rescore this bill. So the bottom line is, inside that 10 years, if you sell an asset, there is gain to pay. Now, what they did do is they said, listen, if cash is always a bad asset in this incentive, they want you to spend the cash. They said, listen, the QOF can hold the cash for up to 12 months and find a new investment, and you're going to pass a couple testing dates. It's okay. We're not going to tag you with a penalty. You can hold that cash, you can make a qualifying investment, and you get to tack your 10-year holding period. So let me just tell you, I have a client that's come up with this strategy, and that is they buy a piece of property, they develop a piece of property, they get into year 7, okay, they get an offer they can't refuse, they sell the property. Maybe they bought it for 5, they sell it for 10, they got $5 million of gain. That is taxable, right? So it's a long-term capital gains. They'll make a tax distribution out of the million something, and then they have $9 million left. So they give their investors the tax distribution of $1 million plus, and then they're going to invest in a new piece of property with that $9 million, and they're 7 years into their 10-year holding period. So then the next piece of property, once they stabilize, which is usually when your value jumps up the most at stabilization, after that, all your appreciation is based on net operating income divided by market cap. So now we get to 10 years, they've only had to hold the second piece of property for 3, and then they can dispose of it. I don't know if that strategy works. I mean, I'm just a lawyer, so I just hear this stuff, but I can say it works legally. I don't know if it works economically, so.
Ben, can you talk a little bit about 1231 gains, because they create timing issues for investors?
Yeah, so the 1231 question, 1231 gain question was an important one that was addressed in the final regulations. So 1231 gain is gain that's triggered from the sale of an asset used in an active trade or business. And that gain can be recharacterized as ordinary income depending on certain tax attributes of the taxpayer. And those attributes they have to track for 5 years prior to that 1231 event. So it's a complicated calculation that goes on in the taxpayer's tax return. They have to track this stuff for 5 years. And when Treasury came out with the proposed regs, their initial interpretation was, gosh, all of that math has to happen and can't happen and is deemed to happen on the last day of the year. And we think that you should only be able to invest the net 1231 gain, if any, determined as of the last day of the year. Well, we push back on that because the definition is tied to what is capital gain, and the question really is the event that happened to create the 1231 gain, should it be measured based on gross 1231 gains? Well, if they said yes to that, that was going to mean that you could avoid triggering those recapture events in that tax year, because you could move that 1231 gain into a subsequent year and avoid what would otherwise be an ordinary income recapture event, which would be really taxpayer favorable if they were to say yes to that. Well, in the commentary and the analysis, the suggestion was that they should allow taxpayers to use the gross gain. They agreed to do that. But along with it was, you have to bring all of those past attributes along with you into the future. Because in 2026, you're going to recognize that gain. And at that point in time, they're not going to give you a pass on the recapture events that would otherwise have happened. So what they've said is you got to carry those attributes forward with you. In 2026, when you recognize the gain, you've got to report them consistent with the way that they would have occurred had they occurred in 2026. Well, that's still a win, right? Because we get the deferral of the gain, even though it might be taxed as ordinary income in the future, we get the deferral. It also allows us to invest the larger dollar amount. So that was the big win from sort of a tax rate planning point of view. The other thing that came out from it was a couple of mechanical things. They had to decide at that point and tell us how and when to measure the gain. So they said you could measure the gain as the gross gain is happening on the date of the sale event. Or alternatively, if you are an owner in a pass-through entity. So if you're the pass-through entity, you measure it based on the date of the sale event. If you're an owner in a pass-through entity, which means if you're someone who gets a K-1, because most of these are partnerships, taxed as partnerships, then you have a couple of different dates that you could rely on. You could use the end of the year. You can use March 15th, or actually the due date of the pass-through entity, which this year is March 16th. And you have 180 days from each of those measurement periods. And if you're in this window of time where you can still rely on the proposed regs, you have the ability to use the end of the year if you're the pass-through entity, as opposed to the actual sale date. So they gave us some flexibility, and that moves us out to, in some cases, September 11th of 2020 to be able to make a contribution to a QOF.
Yeah, we have clients with gains from January of last year. They have until September 11th to invest. So it's really, I mean, this is a very taxpayer-friendly change.
Okay, I want to keep us moving just so we can get to the more general questions and then other people's questions. Brett, can you talk a little bit about a person who is going to realize capital gains from an installment sale?
Sure. It's actually very similar to what Mark and Ben were just alluding to for a partner and a partnership. So Treasury came out with rules here this last December that said, just like a partner and a partnership, if I've got an installment sale, say from last January 2019, I can elect to either have the gain, the 180-day period that tracks that into my next investment start then, or I can wait until the end of the year. So it's my election as the taxpayer to either do it from the date of the last sale or the final day of that year. And the other thing that's interesting about installment sales is you've got multiple installments possibly over multiple years, and I can have different 180-day periods tracking each installment. So it's another very taxpayer favorable provision. And there's one other thing that I just want to add to what Mark was saying earlier about interim gains and the treatment of, a sale of an asset by a partnership. Treasury came out with guidance last year that wasn't quite as favorable for an individual investor, but let's say I'm an investor, I'm in a fund, and I'm stuck and the fund is not performing well, and I want to get my money out. I have time, kind of similar to that sale where, the partnership or the fund has 12 months to reinvest those gains into another qualified opportunity zone business. If I'm an eligible taxpayer, I'm in a fund and I want to get out of that fund, I can try to sell my interest to someone else, and then I can turn around and invest those proceeds into another opportunity fund. And I think I have 6 months to do that. But the problem with it is that the 10-year holding period starts tacky again. So that's the one aspect of that rule that was not as taxpayer favorable.
Hey, Sean,
Yes.
I wanted to point one more thing. We're always learning little nuances to this stuff, I didn't realize this until I got on a call a couple days ago. When I talked about the 1231 gain and I talked about your choices of the dates you get to pick, it's your election to pick what date. If you pick March 16th, don't invest before then. Okay, because you can't. It won't be a qualifying investment because the clock starts on March 16th. And that dollar you put in your QOF at that point isn't going to be qualifying at that point.
Good point.
Yeah, you don't want to invest too soon or too late.
Right. So you want to be really intentional about the election, the date, and when you put the money in.
Let me ask one more technical question. Let's say you are a person who owns, who has a share of a qualified opportunity fund, and you want to figure out what happens, for example, if you die during your 10-year holding period. So can we talk about the impact of inheritance? What happens if you inherit shares in a fund? Let's also talk about what happens if you get divorced while you're holding the fund, pre or post 2026. Brett, can you start that off?
Sure. So generally, I'll start with a gift. So if there's a gift of an interest, that is going to generally be taxable, and that the benefits won't transfer. Similarly, if there's a divorce, and I've got an interest in a fund, and my ex-spouse takes that interest, generally that's not going to receive the same benefits that I would if I had kept that interest. However, if an eligible taxpayer is invested in a fund and then they die and their heirs inherit that interest, that won't be taxable, and they'll receive the same benefits that the original taxpayer would get, so long as they keep that interest in the fund and follow all the other rules. Now, the one disadvantage is if you're the person who inherits the interest, or you're otherwise a beneficiary of a trust or someone that's passed along, you'll not get the same benefit of the basis step up during the first 7 years. So it's kind of an ironic twist where if someone waits to die until 2026, they get the benefit of the step up, and then their heirs would get the benefit, but not otherwise.
Not that we're suggesting anything that you should be doing to your relatives with QOF interests.
It's clear that Treasury does not like divorces. So.
Clearly, but don't get divorced before 2026, right? Because then you mess up the whole thing. Okay, I want to close out this section of it before we move to the more general questions by asking, Mark, can you talk about the anti-abuse provisions? Because we were expecting that for a long time, and we saw some of that, and some of it's just downright strange, but we saw it in the regs.
Yeah, so the statute has these anti-abuse rules, and Treasury has kind of taken the approach of, I'm going to try to make this very flexible for everyone. And I've got these anti-abuse provisions where I can recast or characterize a transaction. And it's interesting because they have an issue with land speculation. They have a section just on land banking and land speculation, and they give us an example. But really, here's the big issue. And this has been the issue for a while, is what do you do with unimproved land? You buy it. It's not like a 1031 where you can hold. If I do a 1031, I can be an investor, or I can be operating the land in a trade or business. So I can do land speculation. This is not an incentive for land speculation. They want you to do something with that property. The question is, what do you have to do with that property? And so they've said you don't need to substantially improve land, but they've also said that you can't buy minimally improved or substantially or minimally improved or unimproved land with the viewer expectation of not to make at least more than an insubstantial amount of improvements over the next 30 months. So that's kind of been their trigger to say you have to do something with that land. What they didn't tell us is, what does more than an insubstantial amount mean? So if I go and buy land and I'm going to turn it into soccer fields, have I done enough? And soccer fields I'm going to rent out. Have I done enough with that land to meet these requirements? And so they hit us also with these on top of that, they hit us with these anti-abuse rules, and they give us this example of a parking lot. And they say in the example, and they say with the anti-abuse rules that if you're doing something that's inconsistent with the purposes of this program, then we're going to recharacterize your transaction. So they basically have an example of someone who buys a parking lot with the intention of selling it for a gain 10 years later. And so what they do is they pave the parking lot. They actually put the example is kind of funny because they actually have an employee that works on the property, and they have a pay station employee, and they create a structure for the employee to work in. And they say that that is abusive because the actual intention is to hold it for land speculation. Then they give us a counter example, and they say, here you buy land that was used for one type of farming, and I don't remember, they
Pig-
use
pig
animals.
farming.
Pig farming, and now you're going to do sheep farming, and you actually make investments in capital investments in new structures, and you operate this farm for 10 years, and it goes up in price significantly, and then you sell it, and they say that's not abusive because you've made these capital improvements. So my takeaway from this is they want two things to happen. They want you to make capital improvements to these properties. And so arguably in the parking lot example, you're not making enough capital improvements. And they want you to be operating some business that has the ability to expand. Because they really talk about in the parking lot scenario, there's no ability to expand. You got one employee, that's what you're going to have 10 years from now, one employee, versus the farm where you're, potentially you're going to do more stuff and hire more employees. So that's kind of these anti-abuse rules that kind of, within the spirit of where Treasury is going, flexibility, but don't do anything abusive. So that's where we are right now.
Another obvious example from prior proposed regs where Treasury talked about, if you've got land in a building, let's say you've got a 1,000-acre ranch in Montana, and there's a small shack on it, and the land in the shack is worth $5 million, but the shack is really only worth $10,000. You can't just go in and improve the $10,000 shack for $10,000, call it a day. So there's pretty obvious examples like that, but I think there's some other great anti-abuse rules that we might want to talk about too.
Okay.
I think the one that's kind of jumping out in the industry is unrelated party issues, and it's something that we haven't really touched on much, but there's a very draconian rule in the statute that suggests that if I own land or other property that's being sold into a fund, that I can't hold more than 20% of the capital and profits interests in that fund. And that all makes sense. They rely primarily on the 707 the 707 provision in the code, and that's a 50% test, but here, for whatever reason, Congress wanted it to be a stricter test where it's 20%. Well, the final rule came out with a preamble language and an example in the regs that makes it even harder, and there's a lot of people scratching their head in the industry. The working group from Novogradac and others are kind of lobbying the IRS to figure this out, because what they're saying is there's this old concept that dates back to the 80s called circular cash doctrine and a step transaction. And essentially, if I own land and I want to sell that to somebody that's going to operate an opportunity fund, I mean, ideally, I might want to take the proceeds from that sale and invest it back in the fund. And we actually have clients that were hoping to do that sort of thing. But now what they're saying in the preamble suggests that that would be an example of circular cash doctrine, and it could potentially blow up the whole deal. So even if I'm the landowner and I hold 100% of the land now, and I sell to the fund, and I'm going to hold like 15% of the limited partner interests in the fund, and I'm going to put like 1.5 million out of 10 million into the fund, conceivably it could still blow the transaction for me. I can't reap the benefits of the incentive. So that's a really unfortunate outcome from the latest rules.
Yeah, I mean, really, yeah. What they're saying here, what Brett's alluding to is, so they're concerned about cash starting off. Cash is already at the opportunity zone business level. I sell a piece of property to the OZB. The OZB gives me the cash, and then I put it back in the opportunity fund, which puts it back into the OZB. So the cash goes back to where it started from. It's a big circle. And so federal tax law is based on substance, not form. You could call it whatever you want. You might say something's a loan, but the IRS might say it's really equity. No different here. What they're saying is if cash starts off at the OZB and ends up back there, what really happened, you really contributed the property on a tax-free basis to the OZB. And it's a contribution, and we all know a contribution is bad property. A sale is not. And so that's where they're hitting at. And these are, they have these they cite these revenue procedures or revenue rulings from the 80s, but the circular cash flow is a big issue. So if you're selling something to a fund, but then you want to invest in the fund, and it's part of an overall plan, you may have a problem. So so our take on this is, if I sell something to a fund, but then I come in 6 months later and invest, you're probably okay. But if it's part of an overall plan, where on that same day I'm putting the money in a fund, you may have a problem.
Okay, I'm going to stop that just so we can hit some other questions. This is lightning round. So these ones real quick, real fast, because then we're going to have open audience questions after that, and then they can catch you at the break. So think of this as the appetizer. You want them to come ask you for the full thing. This is for all three of you. Ben, maybe we'll start with you. What kinds of deals are easiest to do under the regs writ large?
Single investor, single asset, buying a piece of property that you identified that's sitting on the map. That's the easiest, simplest thing.
That has
you can
nothing
find.
on it.
That's right. Raw land.
Same thing, ground up development, no related parties, buy the property, boom.
Yeah, I would say, ideally, there's no ground lease structure, no complicated lease structure. Ideally, it's in a market that's going to do well. Maybe a campus where you need student housing, where there's a market for housing, you're going to lease up quickly.
All right, let's flip to the other side. What type of deals are the most challenging? Brett, we'll start with you on this side.
I would say the most challenging deals to find equity so far have been rural deals, unfortunately. And I would say any deal with a related party, that's gonna be tricky too.
Mark, what's your take on that?
Operating businesses are challenging right now. We have a lot of rules, or all these rules about mobile property, so, I guess if you're talking about a business that doesn't have, that everything's on site, not such a problem, but, if you're talking about property that moves around, we have some rules on that, but they're still fairly complicated.
Okay.
I'd say the small transaction is really hard to get through all of the cost of getting it done. The brain damage is expensive, the regulation is high, and the reporting is, for a long, long period of time. So small deals have a really hard time getting done, even though they should, even though the math works and it should work. And then I would say multi-asset projects where you've got multiple buildings or multiple rehab activities going on with multiple investors coming in.
So can I ask you, those are the ones that are hardest. Have you guys seen any innovative solutions or workarounds that people have found to get those kinds of deals done?
Yeah, go ahead.
Well, we're seeing a lot of deals where opportunity funds are partnering up, are in a JV partnership relationship with other opportunity funds, So you bring together resources from two different funds and solutions to fix problems, different thought processes. And in fact, many of our deals, we create a fund, we raise money in the fund, and then in the process of our fundraising, we get approached by another fund to invest, and so we end up with a joint venture.
And one of the reasons that makes sense too is because you can't have one opportunity fund invest in another opportunity fund. So we have a lot of clients that team up for the same reason.
Ben, I want to ask you, given what we know about all the regulations and of course the statute itself, what types of investors do opportunity funds work best for? And are different types of investors better off in single asset versus multi-asset funds?
So is the question the smaller investor?
Well, what types of investors work best in opportunity funds, and does it matter versus single asset versus
Yeah, so I think
multi-asset?
there's two baskets. There's the individual that has a $50,000 gain because they sold some stock prior to yesterday. And yeah, and they want to defer that gain and make a real estate investment. Those folks have an opportunity to do that. They're going to want to find a quality sponsor who's got a good track record that works with the right advisors. And there's a few of those that are out there. And they're going to want to rely on their investment advisor to do that. But the other side of it is this JV side, and because we're seeing it as well. We are seeing the high net worth investor or the sponsor that has some folks that have capital gains, and they're able to go do these JV deals pretty quickly because it's a single asset, right? It's something they can get their hands around, and all the infrastructure is built in place around the legal, the planning, the testing, and all of it.
Okay. Mark, I'm going to throw this one to you. There have been several bills introduced in Congress to modify or end opportunity zone tax benefits. Now, I want to point out they haven't gone anywhere, but they've been introduced. What should investors make of those efforts?
Well, we actually in our PPM, we always put a legislative risk factor. And in particular, we talk about the Senator Wyden's bill. And the reason this is an important bill is because Senator Wyden is the ranking member of the Senate Finance Committee. And, he's on the D side, and the Ds don't obviously have the Senate, but he's an important voice in that Senate Finance Committee. And in his bill, the things that he had problems with is some of the zones that he thought were, had too high of a adjusted gross median income. He had problems with stadiums. He had problems with related party leases. They wanted to change the rules. So if you do buy land, you do have to substantially improve the land. But the one thing so none of this stuff is going anywhere. The other thing, the redesignation of opportunity zones is not going to happen. But the one thing that I think is going somewhere is reporting, okay? And there are two other bills to pay attention. One is Congressman Clybourne's bill from South Carolina. And then the other bill is Senator Booker's bill. All three of them have reporting requirements. A lot of the reporting is where are these deals, what is what are the values of the land and the building that you're building, how many employees are you employing? But Senator Clybourne's bill is interesting because he points to some more what I call micro criteria, and that is, they're looking at what are the incomes in those tracts, what kind of quality jobs are in those tracts. I mean, more micro criteria, what is it doing for educational levels, things like that, where you really look at that census tract and determine whether this incentive is, really improving the lives, really impactful for those residents that are in that particular tract. So something's going to happen on the reporting side. There's a lot of momentum. Senator Booker and Senator Scott are working on a bill right now where they're trying to change that 2026 date to 2027. They're trying to give you an additional year to give you the 15%, basis step up, reduction in gain, because we're now at 10%. And Senator Booker and Senator Scott, are really the architects behind EIG on this incentive. So in their bill, they're going to have reporting requirements. And if you want Congress to do anything, you got to be able to show them data, show them results. So we don't have reporting right now. Expect something to happen. In every election year, there's still a tax bill that gets done. And so I do think that at some point, it might be later in the year, but we're going to see something on the tax side. Reporting is not something that's so controversial, so we expect that.
Okay. To zoom out a little, looking ahead, what types of projects should we expect to see developing in Arizona Opportunity Zones over the next 1 to 3 years? Brett, can I start with you on that?
Yeah, I would say we'll absolutely see more real estate development in and around the Phoenix metro area. I think we're going to see a lot more up in northern Arizona as well, in and around Wickenburg, Prescott Valley, and in Tucson. I think there's a lot more enthusiasm nationwide for how easy it is to get deals done here. We've got a very proactive ACA. There's a lot of communities that are proactive and encouraging this sort of thing. I think our zoning laws are generally more favorable than they might be in other regions. We're also seeing more interest for businesses that want to bring in incubators. We're seeing potential investment in rural deals along the border. So I think there's going to be a lot of new deals here.
I think we're going to start seeing some more nonprofits that get together with wealthy individuals to create, whether it's education or healthcare, to create, a building that they can lease to the nonprofit, where the nonprofit will have an option to purchase after 10 years, allow the nonprofit to run a capital campaign for 10 years to come up with the money to buy the building.
And I think you're going to see the operating companies expand here. I mean, once you have the place for them to operate their business, I think you're going to see them figure out the mousetrap to take advantage of the rules. Arizona is a great place to bring in talent and find talent, and I think that will be a big deal.
Okay. What can we be doing, the people in this room and us up here, what can we be doing in Arizona to get the most benefit out of opportunity zones and funds?
I wrote down to support you guys. I mean, you're doing a great job of getting the word out and creating forums for this. I mean, this stuff's complicated. It's, it takes a lot of studying. It's easy to get it wrong. And so I think continuing to support organizations that help us get the word out, that's one of the number one things. And then just, you know, as we get to this reporting, we need to tell the story of the good things that are happening from projects, because the degree to which we can do that helps perpetuate, you know, good legislation that's friendly.
I think it's important to have funds that are based here. I mean, so much of this capital is agnostic. You know, they're just chasing yields. And so unless we're bringing to the table the same yields that they have on the East Coast, you know, a lot of that money might, you know, go to the East Coast. And so if we have funds here, funds based here will care about their own backyard and look to make investments here. So I think it's really important to create more funds here. So I think, and that's all about education. So that would be my takeaway.
I would add to that, you know, ideally there could be more resources at the state and local level to subsidize funds, especially funds that are building affordable housing potentially, or workforce housing, or nonprofits that have, you know, more community-minded initiatives. You know, it's hard to get these funds, and it's hard to get a deal done. You know, because of rents and the restrictions there. But if there were other, you know, soft subsidies available from the cities and the counties, or from the state, or resources like the GIPLET or other tax abatement resources, I think that would go a long way.
Okay. Well, you've all sat very patiently listening to us and listening to me. So I want to open up the floor for questions. If you have a question, if you'd raise your hand. Paul, do we have a mic that you can go around with so people can hear? Okay, I think we have someone over here, gentlemen. Put your hand up, sir, so that he can see you behind. Sorry. Thank you.
To what extent do improvements from an environmental standpoint, taking out underground storage tanks, contaminated soils, things of that nature, do those count as improvements as part of this program?
I've interpreted that as yes. In fact, there's a provision that says if you buy property in a brownfield, that as long as you make enough improvements as required for the safety issues under environmental laws, that's original use. So you're not required to have to double the basis. You know, if there's a building on that, all you have to do is get the property up to safety standards if it's a brownfield. And I don't do environmental law, so I don't know much about brownfields, but they obviously, the EPA had a lot to do with putting this provision in here to try to see some more improvements of, you know, properties that need remediation.
Other questions? So I just want to make sure everybody can hear you, because this room is very long.
This question came up at Phoenix Startup.
Go ahead, Brian, but then pass it over if you would.
This question came up at Phoenix Startup Week last week. What happens if a fund invests into a company in an opportunity zone, and let's say 3 years from now, the whole company up and leaves?
It's a problem. I mean, I mean, it's a big problem. I mean, I was just at a conference speaking in San Francisco and dealing with the VC community there, and that was their biggest gripe, is that why do I have to stay in an opportunity zone for 10 years? But that's the whole idea here. It's an investment in the community, and Treasury believes 10 years is that minimum investment. Now, there are almost 8,800 census tracts that are opportunity zones around the country. So you can up and leave one, but find yourself in another. And so the idea is that there are plenty of opportunities to move somewhere in another census tract.
You know, just to add to that, though, I've heard out of the 8,700 plus zones, I mean, 10% might see investment if we're lucky. So, you know, it's hard to say where they'll go.
Can you pass the mic?
Yeah, I have three questions. One is, do we know what on the deferral of the long-term capital gains, if there's an increase in that rate in 26, would it be today's rate or would it be 26 rate?
2026.
It would be that rate. So that could be a huge risk the way things are looking.
Well, I mean, the capital gains rate has been as high as what, 28%, as low as 15% since I've been practicing. So, you know, I don't see that, you know, it's hard for me to believe just based on tax policy that they would increase that rate above 28% on the long-term capital gains rate. The short-term is a real risk, right? Because that's based on ordinary income tax rates. And so short-term is a much different deal. That could go up a lot higher.
And then on the unimproved land, why don't they just put a percentage, like 30% of what the investment was? How come they don't do that?
I asked Treasury the same thing. In fact, I asked Dan Kowalski that, and he thought that they wanted that flexibility, that there's a facts and circumstance test based on, you know, your particular circumstances. This might be good enough. There's an example in the regs where if you look at the example, it looks like 37.5% was enough. And so, you know, that's what I tell people, as long as you do 37.5%. I mean, very few deals I have where people are buying land and not putting more than double the basis in.
He actually, I was listening to an Opportunity Zone podcast when Kowalski was on it, and he actually almost said verbatim what you said about the example that he used.
And we should say Dan Kowalski is a senior advisor to Treasury, to the
I'm a
secretary.
big friend of Arizona.
And then the last question on that circular stuff you were talking about, I thought you said that if it's 20% or less, then it's okay. And then you said maybe not. Then maybe, you know, 15% might be too much, or you have to wait 180 days.
Right, no, so it was okay until the final rule sort of, it pointed out that there's this circular cash flow doctrine that it's always been around, but we have to be mindful.
So the 20% was okay before?
It's still okay, potentially. It depends on the facts and circumstances. But what we were talking about was when there's a related seller that's actually contributing that cash from the sale into the fund. So we don't know if that's okay yet.
Yeah, I mean, the example, let's just say I sell something to an Opportunity Zone business. 6 months goes by, and I'm like, I really like that. I know that property, so I want to invest in your fund that I just sold the property to. But if I'm going to invest 20 million, and that's more than 20% of the, you know, capital in that might be a problem, right? Because the seller and the buyer are related. 20% is that relatedness.
But one way around that, I think Mark alluded to earlier, is with a ground lease. So if I own that land and I ground lease it to the fund, that's one creative vehicle.
Yeah,
to
you
get
could be
around it.
related with a related party ground lease.
Jimmy?
Yeah, do we have any other?
Speaking of giblets and Dan Kowalski, have you started the request for the private letter ruling on how they're going to treat giblets? Mark?
I know someone's requesting that, but we've done giblet deals, and the giblet is a transfer, right? I mean, you know.
Okay, I think we're going to stop. Can you guys talk about what a giblet is for people
Yeah,
who don't know?
so the giblet is, and I haven't lived here long enough to understand the full history, but the bottom line is, I guess, under our state constitution, it says you can't abate real property taxes. So folks, what they would do is they would move the title to the property to the government and then lease it. And they'd say, okay, we don't owe any property taxes because the government's holding title. We can get it back at any point if we want to sell the property, but governments don't have to pay property taxes. And so then the state of Arizona said, well, we're going to start taxing that lease you have with the government. So they put this lease excise tax in there. And then everyone said, wait, but we can abate the lease because that's not really a real property tax. So then they started abating that tax. And then the state of Arizona said, okay, we'll allow you to do that, but not over an 8-year period. And the property has to be in a central business district. And so that's where we are right now, right? You have to be in a central business district. You can have no more than 8 years of abatement. And then it says that at the end, I think, of 25 years, it automatically reverts back. Like, so they can't, so the lease excise tax is a little cheaper than the property tax. And so they say that at the end of 25 years, it has to go back to you. And so we've looked at that and said, well, from a tax perspective, again, tax is based on substance, not form. It's a tax nothing. So there's nothing that's happening here. So we've done GIPLA deals with the OZ incentive and have not had a problem, you know, so that's our take.
So investors have invested, they felt comfortable with it?
Absolutely, yeah.
Someone else, Jimmy, if you had a question.
Back to the related parties clause or something related to that. Could you speak about the service fees that someone can provide and contribute to a qualified opportunity fund? Can you also participate if you're contributing service fees, if it's a developer fee or being an attorney or whatever that may be. Architect.
I mean, in the sense of, in getting like the 10-year benefit?
Yes.
Well, you don't get the 10-year benefit on the carried interest. They made that pretty clear in the final reg. So we had clients that wanted, their idea was, okay, I'm going to put some money in, maybe it's 5% of the capital, but then I'm going to take a carried interest. I get 25% of the profits, but then at the end of 10 years, I'm going to get this big windfall that's going to be tax-free. And the IRS said no to that in the regs. I mean, they basically said carried interest, you do not get the 10-year benefit. So there's another structure that people are doing, or they're thinking about doing, and that is the sponsor will put in equity into the deal, and they'll take a higher preferred return because they'll be lower on the waterfall. They're taking more risk. So maybe the investors are 6 to 8%, but then the sponsor will say, but my dollars, I get 10 to 15%, but I get paid after you anyway, so it's the risk of my capital. And so they're trying to disguise that. And that should get the 10-year benefit as long as that's reasonable, that 10 to 15%.
And to bring it back to your question on related parties, so what's really tricky in a related party deal is that it's not just, say, I've got the land and I'm going to invest 19.9% of the equity into your fund. If I'm going to take 50% of the back end, that's the so-called profits interest, so that's where you can get into trouble.
We have time for one more question. Is there anyone else who has a question? Sir, up here, can you get, sorry.
Well, while you're walking, I'll ask one up there.
Okay.
On a true social venture nonprofit workforce development initiative, what sort of a rate of return are funds looking for?
On the impact side, I mean, like impact investing?
Sounds like it.
Yeah,
I can go ahead and start answering that question.
Yeah, Patrick knows the answer on that.
Stay tuned for our second panel too, because Patrick's on that one.
I came from the private world. I've only been at Centroid Approach for less than a year, so I'm learning, basically equity raise parts. I've seen it at 9%, 10% minimum. Also, there's a very good social impact story that's coming with that. I haven't seen anything below that, and I've been talking to a lot of social impact national funds that are very, very large, all the way down to smaller philanthropic foundations. But I'm at the 9% of the very, very minimum, and that's actually before any opportunities on benefits that you can pass through, such as tax depreciation. But 9% leverage IRR is what I'm seeing, and able to raise that, but nothing below that.
That's, let me just say, we're going to have, this gentleman's going to ask our last question. Then we're going to have a 15-minute break and reconvene at 3:30. And our final panel will be investors, funds, developers, for-profit and nonprofit, including Patrick, who are going to talk about the projects that they're doing, the projects they're planning, the challenges they've had, all that good nitty-gritty. But I want to give this gentleman an opportunity to ask the last question.
Okay. I want to thank the panel for your time. My question is regarding non-real estate related businesses. For example, I'm working on a technology company looking to raise money from investors. Is there an investor benefit to using this type of setup?
Sure. I mean, what we're seeing on a real estate deal is, if you're going to generate a 10% cash on cash return, this might bump it up to 3%, to 13%, 14%. But, if you're talking about an operating business, you could get, I have a client that invested $100,000 in a Silicon Valley company and then is now selling, his proceeds of the sale are 38 million, right? I mean, the amount of potential exclusion is significantly higher for an investor. It's more risky, but it's significantly higher. And this incentive was intended to finance venture capital startups, right? The key thing is the 10-year hold, right? That's the one thing. Like, do you have investors that want to stay in for 10 years? That's the question. But otherwise, if you're located in the opportunity zone, it's a startup, that is a much better profile than an existing business that's in an opportunity zone. Startups are kind of where it's at.
I would just add the other challenge is to get leverage. So it's a lot easier to get financing on a real estate fund than it is on a business deal.
Okay, I want to thank our panelists, Ben and Mark and Brett. If you are a member of the next panel, please come up and see me at the start of the break so we can get set. Everyone else, we'll reconvene at 3:30. Bathrooms are across the hall. Thank you. Good to see you. Yeah, right. Moving closer. Part of it I can't figure out. Hi, how are you? Good to see you. Well, we're going to be over here. There's not going to be any more. Speak close to your mic. We're the only person who's- Ladies and gentlemen, if you would be so kind as to take your seats again, we're going to kick off our final panel with the viewpoints of developers and funds and people who are getting opportunity zone work done here in Arizona. We don't want to miss it, so please have a seat.
Testing.
Ladies and gentlemen, if you would be so kind as to take your seats, we're going to kick off our final panel. I know you all want to get out of here by 5, but at the same time, you want to hear what the people who are doing Opportunity Zone deals in Arizona have to say. I think this is probably the largest panel that I have worked with on an Opportunity Zone project, but we really wanted to make sure that we could share with you a variety of viewpoints on how to do projects and funds here in Arizona. So just to make this easy, I'm going to let them introduce themselves because they can certainly do a better job than I can. And I'm going to ask them to take a few minutes, maybe to give about a 3-minute synopsis of their engagement with opportunity zones and funds. What have you been doing since this statute came to life? Let's just, for the fun of it, we'll start at the far end with Patrick. And folks, when you're speaking, please make sure that your mic is on so that it is green instead of red. And please keep it, close to you. It doesn't have to be right in front of your face, but keep it close. So that would be very helpful. So Patrick, if you could kick us off.
My name is Patrick Quigley. I'm the Director of Opportunity Zones.
So I'm Ed Grant. I'm Executive Vice President with Scottsdale Investment Management, or SIM. We are a 40-year-old real estate syndication firm. We've been based here over those 40 years. Our founding principals are actually still part of the company, although they're coming in less and less. Throughout the decades, we've seen a lot of cycles in our valley, and there have been many opportunities that have come up, and our firm's position is that opportunity zones are something that are incredibly unique. Our little sort of morbid joke is the only way to get a step up in basis now is to die. But, we like to obviously be a little more pragmatic, and I'm disappointed to hear if you lose that, if that happens in your deferment period. But anyway, we're looking forward to continuing to see our valley as a whole grow and use the tools and what's available to us through opportunity zones to enhance our returns to our investors. And I'll get in maybe to specifics later. But all of our projects are actually focused in Arizona. And we're very, very optimistic about the use of these tools, and engaging counsel and making sure you do it right along the way is really critical. And again, we'll talk about that more.
Gary Linhart, I'm the founding partner of VioWest Group. I'm actually in the process of spinning out into a separate company that's called Westhawk Capital. But here on behalf of VioWest, we are a diversified commercial investment and development firm based here in Phoenix, 16-year-old firm. And I led the efforts to do some opportunity zone transactions. We currently are developing 2 projects in the industrial sector as well. And there was a third project that we decided to not do opportunity zone, although it fell in an opportunity zone, and there's some reasons why we chose not to do that. And that might have been why they let me on the panel, to talk about the pros and the cons. So we are developing two buildings totaling 150,000 square feet, just about a minute south of the Sky Harbor Airport. That is under construction right now. And we have a 25-acre site that will be developing 3 industrial buildings totaling 410,000 square feet in Goodyear. And in one of the transactions, we did it in a syndication. For those of you who don't know, a syndication is where you're raising money from high net worth individuals that get pooled together into a transaction. You can do that in a fund, or you can do that on a deal-by-deal basis. We have done funds. We're primarily focused on deal-by-deal opportunities within the opportunity zone, although anything you do is a fund. Generally speaking, a fund is when you're doing multiple investments. And then the second transaction, the one in Goodyear, we actually have an 85% joint venture partner that does have a multi-asset fund. And then we put a fund together for 15% with a syndication. And then those 2 entities, which are funds, the joint venture is at the what they call the QOZB, the Qualified Opportunity Zone business level. And so we're flexible in how we can operate and structure things, and that's kind of what I focus on, or have focused on at the company.
Good afternoon. My name is Nathan Cabell. I'm with Revitalize Partners. We're a new fund, as are many. And for us, our focus is on commercial and industrial development. We have several projects in Texas and Seattle. 2 of the 6 partners are based here, including myself. So we plan to come to Arizona soon. One of our big challenges is really scale. And so we're going into municipalities where we have relationships and building infrastructure, using that as a test case, mostly in rural solutions, and then scaling that to larger opportunity zones. A couple things that are a little bit different about us is our focus is on the community first. So, there's 31.5 million people in opportunity zones. So I don't know if you all knew that number. We all know there's 8,760 op zones, but there's 31 million people in those zones, and that's what we intend to drive and improve. So our strategy is really focused around kind of 3 main areas: healthcare, light manufacturing, and then distribution. When you really think about it, those 3 verticals are several industries that provide a lot of jobs at scale and in concentrated locations. And we can also decentralize that model for a couple of them. So that's our big focus. Rural health is a big deal. If you look at emerging trends in healthcare, access to patient care is a big deal. So providing a solution in that space and making a nice return at the same time for our investors is a great example of the spirit of the tax opportunity zone coming together with land and business development. So that's our focus.
So my name's Chris Loeffler. I'm the co-founder and CEO of Caliber. We call ourselves the Wealth Development Company, and our primary focus is building wealth for high net worth individuals through real estate and real estate related investments. Beyond that, we are a vertically integrated real estate investment firm. So we raise capital into funds, we manage those funds, we do investor reporting and all those things as well. We also actively deploy the money. We have an acquisition platform. We're a developer. We're a general contractor. So we kind of do it all. And then we partner with just about everybody in the world that does parts and pieces of that as well. So we do joint venture partnerships as well, just as you guys mentioned. Oftentimes there's a developer who's worked on a project for quite a long time that we're able to partner with, and that's usually a good fit. Same thing on the general contracting side, same thing on the capital side. So we try to play well in the community that we live in. We're a regional firm, so we're focused primarily on what we call the greater Southwest growth region, which is, in our minds, Arizona, Colorado, Texas, Nevada, and Utah. Although we do have a project going on in Boise as well. And in general, we focus on what we call middle market real estate development. So that's a $5 to $50 million transaction that kind of fits that sweet spot between a project that's usually too large or too complicated to execute if you're a smaller investor, or too maybe small or too complicated to execute if you're a larger institutional investor. So we do all of that. Our largest holdings these days is in hospitality, followed by multifamily, office, industrial, retail, you name it, self-storage. And on the opportunity zone side, we represent one of our funds is a $500 million offering that's raised about $80 million so far this year to date. We've got about $100 million in existing projects in the fund, and then another $100 million in the pipeline to acquire in the next, call it plus or minus 12 months or less, across the board. So I'll give lots of project examples as we go through, and we actually have made some other more interesting investments along the way, but it's been a great program, and spend a lot of time talking about opportunity zones these days. So I'm happy to share everything that I possibly have found out or know.
Caliber is great. My name is Jimmy Flores, and I'm the co-founder and CEO of Qualitics. Qualitics is a community-first technology company that manages big data in order to help foster investment in opportunity zones. We provide an advanced acquisitions platform within a private marketplace for stakeholders, such as investors, property owners, or developers. We specialize in development in opportunity zones, specifically rural, tertiary, and underserved communities. So, when those attorneys were talking about the three that were not so good, yeah, that's what we decided to focus on. We're looking to find and foster hidden potential in local opportunity zone communities. We've created a way to capture, verify, and qualify data quickly and efficiently for investments that not only have the highest impact for the community, but also a substantial return on investment. For example, a real estate development in Douglas, Arizona. We're focusing on building an industrial and transportation park down there. We have over 2,000 contiguous acres in one of the most prime areas for development in Cochise County. Another example, a business development example, would be a local company named Juice, and that's with 2 U's. And they're dubbed the Netflix of power. They've found an affordable way to wirelessly extend the power grid so mobile people have access to mobile power. Arizona has the chance to be the sandbox of 2 unique examples of opportunity zone case studies and investments not readily found anywhere around the country. We are driven by our passion to help communities in need. More specifically, communities in need here around Arizona. I love Arizona. When speaking nationwide about opportunity zones, I push for investments to come to Arizona, starting with opportunities in Greater Phoenix, Yavapai County, or by the border in Douglas. The spirit of the law intended to help local communities in need. Qualitics exists to prioritize focus on these communities because I don't just believe, but I know, based upon the data that we collect, that there are great opportunities to find. Thank you.
And if I could just follow back up. So I left out too. So CPLC is actually working as well with Qualitics. So they came to us about a month ago, and we really like it as a nonprofit. We're also a CDFI It's a community development financial institution. And on top of that, we're a CDE, and the CDE actually is the one who applies for new market tax credits. So we love the new market tax credit opportunity that we could share potentially with Jimmy in rural. It's a high-paying jobs, and for us as a nonprofit, as a CDE, to deploy new market tax credits, it works very well with us. So we're very happy that they came out and sat with us to discuss their project in Douglas.
And one thing too, I feel like I've JV'd with half of you guys in here, so I can't shout every one of you out, but thank you.
We have a very collegial panel up here. So I want to start you guys off actually with the questions that I ended the last panel with. And Chris, I'd like to start this one with you and go this way in part because you two are fund sponsors. And that's with some level of detail, I'd like you to talk about what have been the easiest or perhaps easier types of projects to undertake in opportunity zones, and what was it that makes them easier?
So actually, I think every project we've done so far has been fairly easy. Mostly because we're a big believer that these zones are great places to invest in general. You know, I think that everywhere that we've focused on, downtown Mesa, downtown Tucson, Phoenix, et cetera, have been just places that we've always wanted to invest. This is just getting us an accelerant to invest more and more quickly, and typically into projects that we may not have originally done. So I'll give an example of that as well. So the projects themselves, if they stand on their own 2 feet, have been easy for us to invest. The capital side is harder because you got to find people who happen to have a capital gain, and there's a whole kind of complex issue around getting the money into the funds and dealing with institutional investors and that kind of stuff. But in terms of doing the projects so far, they've been easy. I don't know that's going to always be the same, but so far, so good. As an example of a project that we did because of the Opportunity Zone Fund that we wouldn't have normally done, I was just talking to Nathan about this. We invested into essentially an adaptive reuse. So there was a defunct, empty, old assisted living facility that we acquired across the street from Banner University Medical Center near downtown Phoenix, 60,000 square foot facility. We brought in a doctor who had 4 other facilities in Indiana to create an acute care behavioral health hospital. So it's essentially delivering services for folks who have behavioral health issues as well as other comorbidities that they're dealing with. And so we're in construction on that. Right now, I think we're about 65% complete on renovations, scheduled to open at the end of the year. It's as much as it's a great real estate investment, it was too niche. It was a little scary. Behavioral health, hospital, medical is a little outside the strike zone of normal real estate investment. But because of the program, it's 10-year capital, it's a 20-year lease, it fits perfectly into that right box. And so I think that this program is fantastic for our community because it aligns a very flexible form of capital with the types of projects that the community would actually benefit from. So it's a phenomenal deal. We're not only committed to do this, but 4 more with this particular doctor group. So the next one will be our deal in Boise, and then we'll continue to grow that from there. So far, our projects have actually been pretty easy to execute on. I think for most people that I've talked to that are looking to bring an opportunity zone deal to fruition, the main struggle is access to capital, which I think will continue to be a diminishing problem. It's been a big problem over the last 2 years because they didn't finalize the rules till December. So, there's no financial infrastructure, and most large institutions would not take the risk of putting their clients into opportunity zone investments if they didn't have final rules from the government. But that will be a diminishing problem over time because as the rules become final, as the product has become mainstream, the investors are demanding it in places like Wells Fargo, Abbott Downing, you name it, need to fill their clients' requests to find opportunity zone funds for their investors. So that's now becoming a real thing. I think the capital raising the last 3 months of last year was double what the entire year was, or something to that effect. So there's hope for those of you who have projects that have been looking for capital.
So Nathan, I know that you guys are just starting to look at Arizona, but thinking about your other projects, what have been the easier projects?
Yeah, so for us, we have about 9 MOUs signed. We have 2 contracts pending. So again, we're just starting out. The easier projects for us thus far have really been relocations into opportunity zones, so existing businesses into opportunity zones. So in this case, we have land under contract. We're going to build to suit a facility for, in this case, a plastics company, right? It's a small privately held business. The gentleman who owns it is the principal. He's retiring. He's 84. He's retiring. He wants to sell. It's not a family business. So he's going to sell that business to us. The great news is the book of business that he has could double if he had the capacity. He doesn't have the plant and operating equipment to double the capacity. So there's a triple whammy to this particular play, which is we acquire the business basically, close to book value. We then double the capacity of the business, right? And at the same time, relocate it into an opportunity zone. So the benefit to us is obvious, but that will generate a ton of cash for us, right, as well. And so the challenge as a startup is balancing this demand for capital, whether it be raising equity or raising fund dollars, but also just the returns and generating enough cash to fund other investments. So that's a great footprint for us and a great start, which will employ quite a number of people in a rural setting. The second piece, in the healthcare example, this one is in a state, and all state regulations are different, so I'm less familiar with those in Arizona. But speaking to the deal that we're working on currently, there's a physicians group that we're partnering with that will provide healthcare services in the hospital that we intend to build and fund. And from that perspective, they're restricted in how they can invest, right? They can't own the license for the hospital, for example. They can't own or invest in any of the capital equipment, right, that's purchased in the hospital, the CTs, the x-rays, the MRIs. And so we have to carve out, right, portions of the deal that they can't participate in. So when you think about regulatory and compliance and just managing that, right, as a new business, that's a bit of a challenge, but something that, we have an audit background and expertise in. So we're confident that we'll have the routines and controls, but it's just yet another thing to think about.
Oh, we're going to get to the challenging ones, don't worry.
Yeah. So one easy one hard one.
Gary?
Talking easy or am I talking hard?
Let's start with easy.
So the traditional industrial development for us makes a lot of sense for opportunity zones. You can get the projects built within the time constraints in terms of when you have to deploy the capital. The turnover costs on the tenancy, if you end up losing a tenant along the way, the capital expenditures aren't very high, so you don't have to worry about an alternative source of capital down the road that might not be then opportunity zone equity or so on. And it generally appreciates over time. Rents go up, inflationary rates or more. So we found that basic industrial ground up development fits very well into this program.
So I'm going to, very similar to what Gary said, I'm just maybe going to throw a little wrinkle in it. We think the best projects are the projects that offer sort of some income element out of the gate, but also offer a development element for, in terms of the substantial improvement requirement. We recently acquired an asset in Goodyear that has proven to be very effective. And we have, in this case, a third generation, 53-year-old furniture operator who has wanted to do a sale leaseback. And so we were able to acquire with a new 10-year lease in term, which is obviously coterminous with the sort of our horizon. But yet, I think the total project was about 29 acres, but it offers about 20 acres for development, again, in Goodyear. And, Goodyear's got a really hot bat right now, thanks to what ACA's been doing. They have had some substantial projects out there. So to answer Sean's question, for us, if you can have some income out of the gate, we're typically, again, we're syndicating, and we're doing that mostly with friends and family. So the day that we acquire something, we have capital that's, ticking along at a pref that we have to pay. If we can have an income that's preferably going to produce more than the pref out of the gate, that's all the better for us. And that's really the criterion, sort of the highest criterion that we're looking for as we go forward and what would constitute kind of an easy acquisition.
So for us as a nonprofit, the easier plays are plays where we can partner And we're going to be partnering with Fortuitous and Industrials because it's light manufacturing. So it's going to provide a lot of jobs into key opportunity zone tracts. And 90% of opportunity zone tracts actually fall within new market tax credit tracts. So for us as a nonprofit, we can bring in cheaper money to the capital stack. We can bring in other layering of programs from the federal government. And then also too, we have grant money that comes into us as well that we could put into the project itself. So from the opportunity side, from the nonprofit side, it's all about driving jobs, high paying jobs relative to education level. And so for us, that's setting themselves up to be the easier plays. And we're just forming this partnership, but I've done all the underwriting. I really know what's happening in the Valley relative to costs. And I just have a good feel. I just know where the numbers come that moving that forward, it's not going to be as hard of a challenge as it could be on other stuff that we look at. And then to go back to the challenging side, we do not have expertise in operating. And so for us as a nonprofit, a lot of operating opportunities come to me and to my desk, but I don't know ultimately how that I would internalize that within our own organization relative to skill set and efficiencies. So we haven't played in the opportunity side of the business.
I love my position in the industry because we are not a qualified opportunity fund. However, we serve qualified opportunity funds and other stakeholders in between. The more data that we get, the faster a decision that we can make. And if we can make a decision quickly, we'll go to our arbitrage fund and secure a deal faster than a qualified opportunity fund, theoretically speaking. However, our first two deals took us about 2 years to get to where we are at now because making sure that it's papered for when the deal is done, when a qualified opportunity fund wants to write us a check and buy us out or have us participate, we have to make sure that all of our I's are dotted and our T's are crossed because we are preparing these deals for the qualified opportunity fund, even though we don't have any time constrictions. So even with our deal with Juice, I mean, that was 2 years in the making. We're already almost there. They secured ASU and we have some good traction going on there. And our deal with Douglas, I mean, you know, we were bringing in Chinese manufacturers. We were already going to get to the point where we had a tenant ready to go. We're working on the master development plan, getting that approved. But because of the coronavirus, we have to take care, you know, we have issues going on there on that side. But doing all the hard work and figuring out how we can fill in the gaps for any stakeholder in between, that's our service that we offer. And, you know, even though we might have restrictions, we're trying to do the hard work for you guys. So that's our position.
So I'm going to flip this around, and I want to ask you guys to be kind of specific, even though I know that's a little bit difficult. But let's talk about projects that have been challenging, including projects you may have walked away from or projects for which the financing may have walked away from you. What have made those deals challenging or perhaps, at least at this point, seemingly impossible? And if it's a deal that got really close to that you were able to salvage, how did you overcome the challenge? Now, I'm just going to ask if there's somebody who wants to start with that one, because I realize it's a difficult one.
That one.
Okay.
So our airport industrial project was part of a 2-property portfolio that was being sold. The other project, and that's on 9.2 acres. The other project that was vacant land. The other project is about a mile south of downtown Phoenix, and it's a 25-acre project that had probably 18 acres of vacant land and then 2 existing buildings. One was for 12 years vacant freezer storage building, and the other was an occupied with primarily a triple net lease with 3 years remaining, 196,000 square foot industrial building. So this project, we got it under control around a year ago. So this is last year, 2019 was the last year to get all of the benefits of the opportunity zone economically, but you had to deal with a lot of uncertainty. As Chris mentioned before, the final regs didn't come out until December. And this project had checked all the boxes of all of the areas that were uncertain during last year. There's this aggregate rule about whether you had to double the value on each individual property or you had to do it in aggregate. And we were closing in May. So we weren't prepared to close with that uncertainty and expose our investors to the risk that the rules might come out favorably, whatever probability you gave to that. So one of our solutions was to potentially, this was like on 6 different, we could split it up at the 6 different projects and maybe separately parcel them, and then one would be out of the zone and the other 5 would be in, and it was getting very, very complicated. The other issue was whether what would we do with the building that had a tenant in it for 3 years that was on a triple net lease, and then that would probably have to be out of the zone because you'd put the capital improvements on if you didn't get the aggregate after the 31 months. So fortunately for us, we have the ability to raise money on a deal-by-deal basis in different kinds of capital sources. And so literally 4 weeks before we were supposed to close, we decided, and first and foremost, we're looking at each opportunity that it should stand on its own as an investment. We're not forcing ourselves into an opportunity zone investment that otherwise wouldn't be a good real estate transaction, but it does open the door for us to invest in things and take a longer term view than we might otherwise do on a traditional project or for certain kinds of investors. So about 4 weeks before we were supposed to close on that, we decided that it was too complicated and the tax tail was sort of wagging the deal dog. And we pivoted and went out and got an institutional partner, and it's not an opportunity zone investment as we stand today. We've closed on it. And I think that was actually ultimately, even if the regs all kind of came back favorable, that we could have done it with the aggregate rule and so on, and we could have worked around with the triple net lease and by doing certain things, and there's still some things that aren't clear on that. But it does give us some flexibility that some of the assets within the project, we might add substantial value very quickly, and it wouldn't necessarily make sense to hold it long term. If we get a single tenant lease on the existing building or get an extension on that 196,000 square foot building, we might sell that right away because the building's very valuable at that point. And so the flexibility on exit is something that you pick up if there are components of a project where you'd want to sell it before, that we decided, you know, even with the rules as they came out, we're better off having it not an opportunity zone deal. It was too complicated and we like the flexibility.
Gary's story helps me couch my response. We're probably the only company on the panel that has a multi-asset, large, mixed fund. So I'm just making a guess, but so we're not funding project by project, which we believe gives us a competitive advantage to be able to move, you know, into multiple different projects and manage and balance risk across the portfolio and a whole variety of other reasons, right? But having said that, it creates a significant additional layer of complexity in terms of following the rules and that kind of stuff. So to answer your question, I think a little bit more accurately, every deal we've done has been hard from the perspective of making sure that it follows the different guidelines of the opportunity zone funds, the time horizons, the deployment of cash, the active management of the cash between, you know, cash deployed into construction versus not, and all the different components that come into it, okay? So, but we've got, I mean, we're underwriting over $3 billion worth of deals right now. We've probably got $500 million worth of deals in LOI stage or in some sort of form of back and forth negotiation with a buyer and seller or a developer that we're partnering with. And we've invested in 100 million. So if you do the math, it's still a pretty small percentage in terms of what we're looking at. The deals that are not working or too complicated are typically the ones that the other party on the other side of the table, whether they're a developer bringing us the project because they've been working on it or a land seller or whatever, they just truly don't fundamentally understand the opportunity zone tax benefit. Primarily is I have to take that investment and at least double its value over a 10-year period of time. Otherwise, I've created no real economic benefit for my client. I've just locked up their money for 10 years and not delivered them any sort of financial result. So a lot of people don't quite understand that. They think, well, you know, you make 6% a year, that's great. That doesn't do anything to them on the tax benefit side. So the types of investments we have to make are investments that we can at least double the value every 10 years, and that's typically the low side of the expectation over a 10-year period of time. So typically, it's the developer who doesn't understand that, or the partner that wants to bring a deal that doesn't understand that. Those deals get washed away very quickly because someone hasn't thought through that for us and figured out how to do it. And then anything that's not, as to use a term from the Obama administration, shovel-ready, is not typically going to work in most cases, or at least close to shovel-ready, as you put it, because we get capital. That capital has to be deployed within 6 months. The deployment of that capital is then determined on not just placing the money into a QOZB that is going to do something with an asset, but that has an execution plan that's clearly defined that we can put into writing and then rep to every 6 to 12 months, basically. So there's a lot to it. And so for those of you who are in the world of looking at creating opportunity zone investments or bringing on partnership, the more you can fully bake the deal and tell us exactly, we're going to buy it for this, we're going to do this to it, it's going to be worth that when we're done, we're going to sell it for this, and here's the execution plan for the next 30 months. That's gold.
Just a quick note, all of our deals are hard, as mentioned in the first panel. And not only do we have to focus on the requirements with the legislation, but you're battling the team itself in an operating business, right? Qualifying the actual operator. You're battling the logistics of a rural deal. Who's going to manage the asset? Flying out there. I know some of the places that we go to, there's only one airport, and is it even heavy enough to fit in your 757 or whatever you're flying in? And also the capital stack. When securing the Douglas deal, I had to go private money because no one was willing to give me a loan, not even Inca, because it's such an area that not many people understand, right? So educating people on why that's a good investment, no matter what the data is there, people still have their gut feelings, fighting against that. So, and the last point is impact. We focus on impact deals, and we want to measure the impact, the highest and best impact of that community. By focusing on impact first, that weeds a lot of the deals out, and we want to make sure those deals are good because we want to set a good precedent in the industry on these deals can be done if there's a lot more effort into it. So, yeah, all of our deals are hard.
So I'll take a little different approach. The opportunity zones, qualified opportunity funds, what you heard in the previous panel is very, very complicated. And so for us, the challenge hasn't been the deal per se. The challenge has been making sure that we're complying with a new set of laws that are put out by an entity that's not known for being terribly efficient, let's just say. There is significant challenge in that. And furthermore, we're taking money from friends and family that have invested us for decades, and we're saying, if we're going to structure this transaction so that if you give us your money, you're going to get, the step up, the deferral, yada, yada, yada. So there's significant legal risk. And I know that we have different perspectives up here, but our firm, what we tell ourselves is an opportunity zone doesn't make a bad deal good. It just makes a good deal better. And it does. It extends your purview. I think that Gary said that a second ago. And typically we're not going to invest over that longer term like that or look at it over that longer term like that. But now we do for opportunity zones. And I think underlying all of this, you have to remember the spirit of this element of the Tax Cuts and Jobs Act from 2017, which is to make some of these challenged areas better. There is, some pending legislation that could perhaps change things in our very divisive political environment. I'm comforted by the fact that Senator Scott and Booker are on the opposite sides of the aisle, but they're working together. And so you hope that there's not a significant change to that. But again, I just really, and Mark's our attorney, so commercial, but I can't overstate the importance of having good counsel because these transactions are so complicated, they're so new, and frankly, they haven't, a lot of the way legislation gets settled is it's litigated. Well, we haven't had enough of a window to do that, and you hope you don't have to go there, but you really need to be careful, and so that for us has been the most challenging part of opportunity funds.
Mark, do we get billed when it's green or when it's red?
I think one common theme you're probably hearing here, and is those of you who are saying, do I like opportunity zones or not? If you're still trying to figure that out in your mind, is that it's been 2 years and we still don't have very much infrastructure built, and the incentives are starting to expire. So the only way this thing is really going to be successful in a meaningful way for our communities and our country, which I truly believe it is, I wouldn't be up here spending time doing it if I didn't. Because we to your guys' point, we 1,000% believe in the spirit of the law of, hey, why do we invest capital in Wall Street and everywhere else, but we don't invest capital in Tucson, Arizona? Like, what is wrong with us? Why aren't we investing in our own neighborhoods? This is idiotic, right? So the spirit of the law is great, but if we don't extend the law, create more, create a longer period of certainty that we will be able to consistently raise capital in this program, the vast majority of the financial infrastructure that runs our country, that decides where's money going to flow into what funds, are going to say, it's too much work to figure it out. It's almost over. Let's just not approve a fund. And therefore, the people who are sitting on $1 trillion in investment and.
So are you're referring to like new tranches in the future?
Yeah, I'm referring to making sure that if I'm a investor and I go to my financial advisor at ABC Wealth Management or at Charles Schwab or at TD Ameritrade or whatever, that I have 10 funds to choose from, and my investment advisor is educated and can give me advice on which one to go into. Right now, that doesn't exist. It barely exists. And so until that exists, the vast majority of the capital won't come into the funds. Until the capital comes in, the vast majority of the projects won't get funded. And you'll see very, very specific, like rifle approach, oh, this deal got done and it was really impactful for the community. Great. That's awesome. But it's not going to have that nationwide wave of impact of really transforming places that typically don't get capital.
I want to give Nathan and Patrick a chance to weigh in on deals that have been challenging that you got done anyway, deals that were challenging that you walked away from, or that the money walked away from you, because I want to make sure everybody gets a chance to weigh in on that one.
Yeah, I think to build on Chris's point, just in terms of the timeline, if we place the emphasis on the community, one of the challenges that we face is just stakeholder alignment within a specific geography, right? So people know that they want jobs, they know they want above livable wage jobs, but beyond that, in certain communities, it can be difficult to facilitate, right? There's a bunch of different factions, people aren't aligned. And so when you look at our approach, which is community-based, how do we start with the end in mind, thinking about the skill set development, thinking about workforce development to create the types of jobs that we'll need to populate our strategy, right? When we think about light manufacturing, healthcare, and distribution. So that adds to I'll say the length of the project plan and the supply chain, if you will, in terms of training and staffing, right? We don't intend to import talent. We intend to hire people in their own backyard. We intend to hire people in that same zip code, right? We intend to hire people that are going to stay and create communities, right? This is about community development, right?
Last thing you want to do is be 2 years down the road and the program's expired.
And that's so when you combine Chris's comments and the comments made down here with workforce development and kind of community-based focus, it becomes a challenge. We're partnered with one of our sixth partner is a company called Leadership Foundations. They're a nonprofit. They're nationally based. Some of you might have heard of them. They've been in business for over 40 years. They serve about 47 different communities in the United States and are planning to go international. So we're kind of piggybacking with them as a partner because they have inroads into communities and municipalities that we don't, right? And they, oh, by the way, the next leaders in our businesses, right? Supervisors and managers will likely come from people that they've trained and developed in other roles. And so that's a way for us to accelerate it, right? But it's a challenge when you got, scarce capital chasing after multiple projects.
Yeah, to go back to what projects, and unfortunately this is the case, that are very difficult to do, it's affordable housing. So I have only heard of one project nationally that was able to link in LIHTC with an Opportunity Zone fund investor. And that's kind of an unfortunate. So there's a lot of inputs of why that's the case. And I won't go into those inputs, but I know for us at Chicanos Per La Casa, the last 3 months, I've just been working in math and reconstructing a model that our organization had done with United Healthcare on affordable housing, and it worked. It worked very well. And I've been trying to figure out how to make it mathematically work in opportunity zones, because it's not going to be a new build, and so you're not going to be able to double the basis. So I have yet to solve that problem, but we're moving forward on a model somewhat to go national, to work with key stakeholders. And we're going to be looking to stay away from the federal government, the state governments, and model what we had done in the United Healthcare model. And in that process, we're looking and we're talking with bank foundations themselves. We're working with CDFI organizations as well. And then we're going to trying to be anchoring our projects with education institutions and healthcare organizations. And that's what we had done prior. So those are definitely challenges, in my opinion, anything at that affordable level in opportunity zones. But I know our organization is working around it, but we're going to most likely be working in low income and low and moderate income census tracts, and not depending to be looking for that. In this instance, believe it or not, it's about $1 million of the Opportunity Zone Fund investor. So we're going to just be opening that up to any type of investor on our project. That's about a $25 million TDC on a refurbished project.
Thank you. So I want to ask a few other questions. We're not going to go quite lightning round, but if we can tighten these ones up, because I want to get through 3 more questions and then leave 15 minutes for community questions, because I'm sure we have some. And this one kind of plays off of some of what Chris was saying, and that is, how do the regulations, particularly the newest, and I hate even calling them final regs, even though they're final regs, because I think a lot of us are expecting technical corrections and letters and other sort of supplementary materials, shall we say, to amend, but they are technically final regs. So how do all of those regulations affect your investment strategy and or project timing? Is there someone who wants to kick us off on that one?
Yeah, I'll go really quick because I already sort of answered some of that. It creates certainty. Investors require certainty, especially when they're investing millions of dollars. Most of the people that are investing these funds have sold their business, and they're investing one of their largest financial assets into something that they need to not go away. So they can't take on an unreasonable amount of risk because that's where they're getting these larger capital gains from. So first and foremost, certainty. So we have certainty. Second of all, thankfully, the regs for Caliber validated our choice to go into a multi-asset fund. We have a lot of flexibility to sell and reinvest, which helps us compound returns, which means that every project doesn't have to be a home run. We can hit singles and compound them, which is really good for us. And then I think other than that, there's the main thing that I think we're going to see on the regulatory warpath is going to be requirements for reporting, which for us is great because it just gives us clarity on what is it that you guys would like to know about what we're doing and how often would you like to know it. I don't think that there's across the board at every panel I've sat in, I've never seen a fund say, I don't want to report on what I'm doing. They just want to know what it is that they want to report on. So there seems to be some political controversy in Michigash around, we need reporting requirements for these funds, and we're all just like, okay, which ones and when? So I think that that'll be the next round, and those reporting requirements, hopefully, in my opinion, won't be too heavy, because then that's going to hurt all of you, because you're working off a $20 million fund, and I'm working off a $500 million fund. I can pay for a different type of consultant than you can to complete those reporting requirements. And so I'm hoping that they won't be too heavy because they won't be too expensive, because the vast majority of the volume has been in single asset funds.
Yeah, I was going to say virtually the same thing, but to the extent that we can really limit that are complying with these enabling statutes or the rules, as we made the same joke about the final regs, they're not really the final regs. There's potentially more regs coming out. And on the project I mentioned in Goodyear, we had actually delayed our escrow by about 9 months for issuance of those regs. And actually ACA hosted Dan Kowalski here, I think, was that December? And we got here early and got about 10 minutes with him. And And, you know, they really seem to be listening. And again, that's where it's important to have good consultants who will assist in that. So other than the certainty element that Chris just talked about, which is absolutely correct, not having to jump through too many hoops to comply with that. And I'm going to be very intentionally generic there, because like Gary said, if that is the case, then people aren't going to invest, and people aren't going to use that as an investment vehicle, which goes against the spirit of the program, and that's something we want to encourage. So.
I'll address kind of at the real estate level, because I think the compliance level was covered very well. I mentioned before this aggregate rule. That really narrowed the pool of opportunities you could pursue, because you had all these challenges about what you were doubling the value of, or the improvements of, and that was clarified. So that broadened the scope of projects that could be purchased. And then on the back end, the compliance, and Mark and I were just talking about this before, there was uncertainty about whether you'd be able to sell different parts of a project separately, and they came out favorable on that. So now you have flexibility on the front end of buying assets and how you do the math on that, and flexibility on the back end. So I think that the impact was very positive for the universe of deals that you could now do.
On the business side, there was a lot of positivity on the final regulations for operating businesses, which is good, because when there's more positivity, people feel a little bit more comfortable entering into these types of investments. However, on the property owner standpoint of contributing to the related parties clause, that kind of affected our services, because we secure the property as an owner or buyer. If we wanted to sell off to a qualified opportunity fund and contribute and stay in the deal long term, now it's a little bit challenging for us. But that also affects property owners that want to stay in the deal as well outside of us. So that was a little bit challenging. On the impact reporting side, we're doing our best to release free reports, at least basic reports, to anyone that's willing to exchange data to us. So in exchange for data on your opportunities, we'll give you a report, and we'll make it as best as possible that will be compliant to the federal government requirements, plus more if you'd like that. So we're ready for that.
Anybody else want to weigh in on that one? I'm not forcing it, just asking, so I don't cut anyone off. So I want to ask, what can Arizona communities, and by that I mean everybody from the economic developers who work for the cities and the communities, to the nonprofits serving the areas, to individual property owners who own land in an opportunity zone, what can they do to attract opportunity fund investment? And when you answer, tell me if this varies by the type of project, and if it varies by region of the state. So I'm going to say that again. What can Arizona communities, from economic developers to nonprofits to individual property owners in the zones, do to attract opportunity fund investment? And does this vary by the type of project or the region of the state?
On that. So Lisa and myself have been to see everybody at economic development departments all throughout the Phoenix MSA, and everybody has been amazingly fantastic. And what we push a lot is speed to market, speed to market, speed to market. So for us, doing industrials, and if we're going to spec it and take on that additional risk, you know, we need to know that the economic development department and the cities themselves that we're comfortable with being able to get through entitlement as quick as possible. City of Glendale, city manager just spoke a few days ago, and I listened to him talk. He gave an example that they were able to land White Claw, and I don't ultimately know what they exactly do, but I believe they do some hard beverage services in the city of Glendale.
Sure you don't, Patrick.
So I just like, hey, you know, you get to a certain age, you just can't drink anymore because. Yeah. But he gave a great example. I mean, they're going to go from like literally the company's walking in the door, and within 8 months from January to the end of July, that everything's going to be processed and done, and the building's going to be delivered. And it was unbelievable just sitting in the audience saying, wow, the city of Glendale is on top of it. They know exactly what they need to do to land these larger companies that want to do manufacturing and warehouse. So from our perspective, and obviously the JV partnership that we're developing, as we look at sites and locations, getting a gut feel of the economic development teams and really and truly what's the speed of market. It's been everything for us in making our land site decisions.
So I think to understand this a little bit, you have to look at, you really have to tip your hat to Sandra and Sean and the team here, because what the governor did when this came out is ask the ACA to go out and find these tracts. And what they did correctly is they pushed it down to the cities, and they had the cities submit back, and then they looked at them for compliance. And so effectively what you did is you put a city on notice to say, of course you have these guidelines in which these tracts need to meet, but where would you, or where do you think your best opportunity is? And so you're coming into a situation in my mind where, you look at California, for example, and their tracts are very political, very political. So Arizona has already, in my mind, gotten ahead of the curve by not making it political to ACA's credit. I think just like Patrick was talking about, the idea of incentivizing further within the municipalities is going to be important. We don't have tax increment financing here in Arizona, which is something you hear every economic developer talk about. We are the only state in the nation that doesn't have that. So perhaps looking at, certainly speed to market is important, and if you're expediting permits, but if there are sort of ancillary districts, revitalization districts, CFDs, new market tax credits, while those can get a little complicated, they can also serve as an attractive layer, I think, to make those specific areas that, again, the cities have already designated even more attractive.
I'll be real quick and reiterate the speed to market. We didn't have a lot of development in this city for quite a long period because of the downturn. And whether you're talking about the trades or you're talking about getting through the municipal process for approvals, the systems, the muscle memory isn't really there. And we get a lot of frustration in dealing through the municipalities and anything that they can do to speed that up, make it more efficient, run it like a business. I think the more capital it will attract, the more influence that economic development has, and the access to economic development departments to get help through the process. But I think ultimately, if those departments are run like businesses and understanding that being a great place to do business efficiently will promote growth and development and investment in these areas, I think it's positive.
Just one anecdote to add, what Chris said about shovel-ready projects is key. I think, clear alignment around vision and business plans and portfolios that pencil out are obvious. One client that we have, a municipality, really struggled with urban renewal. In this case, it was a small downtown area. They had just revitalized a hotel. Beautiful concept. It's a hallmark of the community in terms of there's a nice coffee house and people come there. We spent an evening there. Great place. So what do they do for an encore? About a block away between this hotel and City Hall is an old block of small businesses and shopping centers that are dilapidated. Well, their plan and in their budget for this year was to spend, $1.5 million raising those buildings and creating a parking lot, right? So we said, you got a great hotel downtown. It's anchored by a few small shops now. You've got some growth and vitality. And oh, by the way, this is about 30 minutes from a destination location that's, you all probably know, it's out of the state. But the point being that, they're in the middle of building this great anchor location, and they want to knock down these buildings, and their version of the best and highest use of this, land is to build a parking lot. And we said, why? They said, oh, because it's in the budget, and we've kind of already voted for it. And so, right? So not mocking, bureaucracy, but the point being is if you approach this from a community impact perspective, it's obvious that's not the right answer. We came in and proposed a mixed use facility with parking for the public, but also parking that would support approximately 50 residents and then an additional 30 retail spaces. Which we felt was a better use and more complementary to what they were trying to do and more revenue generating for that municipality. The key there is we're on the clock, right? Yep. So the buy time strategy, the city had to vote to extend 90 days to decide not to build a parking lot, right? So a little bit of ridiculousness and frustration, But when you talk about putting people back to work as well as building communities, we thought that was the best use. We've since gone out and we're trying to partner with an anchor tenant, in this case a grocery retailer, to be an anchor tenant of that community and have mixed use office and living space for about 50 units. So that's it. I think it's shovel ready projects. We have to have a clear vision, and it starts with public and private working together.
That's amazing, parking lot. So since we've already had such shovel ready, I'll keep that away. Everything I try to tell you is things that are happening in my actual experience, not necessarily things that are that I think, or try to distinguish between those two things. Although the names will be hidden for the protection of the innocent, or the not innocent. So one thing that's working from a city and business development standpoint is we're building a DoubleTree Hilton Hotel attached to the convention center in downtown Tucson. It's a $40+ million deal. We got land incentive, we got tax incentive, and with all that, thank God we did, because without it, there's no way we would have been able to build it, because construction costs are up 35%, since we started the process, right? And so thankfully we had the incentives, because if we didn't, we would have walked. And Tucson, for another 20 years, probably would have been waiting to get their hotel attached to their convention center in downtown, which they've been trying to do for 20 years. So that's an example of something that works. Something on the property owner side that I would, since we talked a lot about the municipalities and the cities, if you're a property owner and you own a piece of property in an opportunity zone, please don't be the person that comes to us and says, hey, I've got it 95% complete and it's an opportunity zone, you want to buy it? No, we have to, if we buy it for $1 million, we got to put $1 million into it. If it's 95% complete, we can't do that. No one wants to buy it, not from an opportunity zone standpoint. And so that's a really important thing to understand as a property owner, not overdoing it with your own activities to try to make your property a certain thing. Being willing to partner and contribute your property into the fund and become a partner and maybe roll your gain into the fund and be a part of it. These deals are not without risk. It's a lot less risky to build, market rate apartments in downtown Phoenix when it's a great market. It's a lot more risky to buy most of downtown Mesa and transform it, which is what we're doing. So if you're willing to take some of that risk along with us, then you're going to get the reward as well. And most of those property owners that do that, I think, are going to see much better execution in terms of getting their deal done. And then, again, protecting the names of the innocent. I'm not going to talk about which cities did what, but I think it's really important to highlight that there is somewhat of a conflict of interest between an opportunity zone investor developer and the way a city typically works. So a city typically wants to play well in the sandbox. They want to give everybody a shot at the deal. They want to make an opportunity that's widespread and has easy access. There's 300 funds in the country, and maybe 30 of them have money at any one point in time. They need to just pick a pony. And so what happens with the cities that have land in an opportunity zone that want to get it developed is, we come in, we say, hey, we're ready to go. We'll do it. We'll do a $30 million apartment deal or whatever, and we're ready to execute. And they said, well, this developer over here said that they want to build, green apartments or whatever. And then 12 months down the road, we've moved on. So the cities need their normal process of kind of creating this widespread, multi-9-month, 12-month process to be able to decide who's going to develop a piece of property the city owns doesn't work in opportunity zones because there's not enough players involved. There's not enough people that are ready to actually execute. And the second I get a deal done with the city, I've got 30 months to execute. So that's just not enough time. So those types of things are really important. I don't know if that's going to change, but that it would help.
I'm going to keep it quick. Data, data is the biggest thing for us from every single stakeholder. Give us as much data as you can. I don't care what it is. We'll figure it out. Communication, streamlined. I've invited many people here that's part of our ecosystem, and they're coming to understand what this industry is and how they can participate better and being creative. So communication between that is key. Fast decision-making skills, whether if you're the service provider that wants to contribute your fees, or if you're the property owner that wants to sell, make a decision because you have to. It's not for us, it's for the opportunity funds that we're servicing. Specific nonprofits for opportunity zones. Opportunity Alabama is killing it, but where is Opportunity Arizona? No, I mean, don't get me wrong. But there's a lot of grant money out there, and these other states are getting it. Let's bring it here, and I will help somehow, some way. Qualified Opportunity Funds specific for Arizona or for Arizona regions. This was already mentioned in the first panel. Where is an Arizona First Opportunity Fund, or where is a Cochise Regional Opportunity Fund? The planner for Cochise County is over here. He part of communication. That's awesome. It came up here. Wouldn't it be nice to have local constituents invest in their own communities, which will then incentivize others outside of the state to invest there too? Reduces the risk. P3s, Chris already mentioned that, and everyone else. And then also local capital support for support organizations, AKA us, to build out solutions for the Opportunity Zone initiative. You know, it's already hard enough to raise money in Arizona. Well, some say so, others not. But find capital to support the people that are manufacturing the picks and shovels for this industry.
I don't usually do this, but I'm going to add a couple things. We have on our website a guide that's really, it's technically for rural economic developers, but anyone can use it. It's really the things you need to know about your properties and how you identify your most likely to develop parcels. Because it is that shovel-ready thing, but it's also the infrastructure. If this plot does not have water, sewer, power, you're not going to have enough time to get that in before the timeline for Opportunity Zones expires. This is one of the things we told people when they were picking their zones. Was like, think about where you can get development in the next 3 to 5 years, because that's the way you need to be thinking, not because we care so much only about the next 3 to 5 years, but the way the law is structured, that's the most beneficial time. The other thing is put your sites, put your projects, put your companies up on the Arizona Opportunity Zones Network, and when you do, make sure you fill everything out. So when someone asks you, how's it zoned? Or they ask you, does it have water, sewer, power? Make sure you know that stuff, because for a lot of investors who are trying to move quickly, that's just information, like Jimmy was saying, the data matters. They're just going to move on to the next opportunity because that stuff is critical for knowing, is this a piece of land? Is this a place where you can move quickly? So I would just say those two things. Check out our guide to rural economic developers. It's on the website on our Opportunity Zones page. And check out the Arizona Opportunity Zones Network. And if you have a parcel, a business, something that's ready to go in an Opportunity Zone that's ready to be sold, make sure it's on there. Okay, I have one last question.
Something I was just thinking, something that Lisa and I talk about a lot, and I 100% agree everything with what Chris was saying. So as economic development departments, whatnot, I mean, you could actually ask, you know, it's not going to change the pro forma materially, whatnot, but Chris, you know, if he's doing a mixed use a building at market rate, I mean, you can come to him and just ask him, hey, give us 1,000 square foot office space down below where we can run some programs out of, like some workforce programming out of, or childcare or something of that nature. It's not going to move much, the internal rate of return, but if that's what it takes coming from the city officials or economic development departments to lock in a partner like that, I am sure that Chris would have no problem on setting aside space within, not large amounts of space, but to run programs for the community. And you could maybe link a little bit on that, and then you can kind of keep going back to the well, to Chris, to keep developing projects in areas that you really want to have developed.
Yeah, we do that all the time. We wrote an impact thesis into our fund to focus on creating community impact. We're trying to figure out how to measure it, as Jimmy knows. But at the end of the day, yeah, in a heartbeat. I mean, right now in one of our Opportunity Zone projects, we're giving free space for an artist to work. We're doing, we host the Mesa Music Festival for free every year. Plus we donate to it. So we just need someone to tell us what they want. It's not that complicated.
Okay, guys, this is the last question. It truly is a lightning round. You have 1 minute apiece so that we can leave some time for audience questions. What types of Opportunity Zone projects do you expect to invest or engage in the next 2 to 3 years, particularly in Arizona? And what do you expect to see others investing in? Nathan, you want to kick that off?
Healthcare, light manufacturing, and distribution for us. That's our central focus. And, you know, I would continue to expect to see, investments in residential, commercial, mixed use as we have been. That's kind of the bread and butter, it seems.
I'm just going to try to piggyback. I'm literally the exact same thing. Our organization is the same. I think we're going to see a lot more investments in operating companies who want to do infrastructure plays, right? So some of the broadband and rural and the other 5G kind of technology. I know Jonathan Tower is Arcturus. He's kind of moving down his business model in that kind of fashion. So I think in the next 2 to 3 years in operating businesses, you'll see more infrastructure play and more broadband play.
I'm going to say industrial and residential, and just so we're clear, that's exactly the same way I would answer the question if you asked where I thought the opportunity was in the market. Again, it has less to do with the fact that these are opportunity zones and opportunity funds, because that's been our model, is to direct the capital where there is opportunity, and then within those sectors, look for opportunity fund or opportunity zones.
This is the lightning round, but you stole my thunder. I would say exactly the same thing. I think industrials, for reasons I've discussed, and housing clearly is one of the big issues in our country. And I think we're like 30,000 or 25,000 or 30,000 units short right now a year here in what we're producing when you add up single family and multifamily together. And there are opportunity zones on which you could build housing, and people are going to figure it out.
We are, I'll take a different focus. So we look at the market first and the actual census tract. So we're in downtown Mesa. So that's a census tract for us. We're going to do whatever makes sense that can create that basic metric of growing the value of the investment over that period of time, whether it's retail, hotel, office, industrial, residential, investing in partially in an operating company as a tenant, whatever it is we're doing, because we look at the market first and we get real excited about what's going on in that sector, and then we try to deliver whatever it is that will work within that market. So we're in downtown Tucson, we're in Mesa, we're in Phoenix, we're going to be in Boise, we're in Salt Lake City, we're looking at Reno, you name it. So we look at the different zones in those markets and we try to serve up what's needed. What we need help with is what's needed.
Highest and best need in any opportunity zone? Rural, operating, and small. That's for ours. That's what we're looking for to do in the next years. And then others, real estate in tier 1 markets. That's just what it is. And hopefully private equity type deals where it's established operating businesses that are moving in opportunity zones, bigger firms.
Okay, so we're at the stage where I'm going to start asking if you have questions, but I want to say the following things. On your way out, if you did not register for this event, but you signed in, please make sure we have all your contact information so that you get on the invite list for future events, because that's literally how we build it. So if you don't have one of the name tags that were pre-printed, that means that we didn't have your name on the way in. So please make sure we have it on the way out, because that way, again, you'll get subsequent information and invitations. Secondly, on your way out, grab another cookie so I don't have to throw them out. I just don't like the waste. And frankly, as my mother would say, better on your waste than mine. So at this point, I do want to open this up for our last 15 minutes today. I've been trying to keep us on schedule, so apologies for pushing you all. I appreciate you being here. So I want to ask, do you all have questions of our panel here, of the people who are doing investments in opportunity zones here in Arizona? Here, I'll just walk out to you. Feel a little like cross between Phil Donahue, Oprah.
Oh, there you go. Thank you all for being here to share your expertise and your time. This is kind of a twist on this. You all deal with high net worth individuals. And when I go out and I go into opportunity zones, I see neighborhood groups, neighborhood business alliances, associations, block watch groups, and they've heard this popular term called opportunity zones. And they say, we want some, we're excited, we want a part of this. Have you ever heard of, say, low net worth individuals aggregating capital gains that might be from a record collection or an antique car or something, putting their money together and looking at, say, blighted properties in their neighborhood and purchasing those for affordable housing or something that patient money over a 10-year period would allow an exit strategy such that they would benefit and sustain or perpetuate that spirit of what the opportunity zone was supposed to be about?
Yeah. All right, cool. I'll keep it quick too. Absolutely. And it's really challenging because they're getting a lot of bad information from a multitude of service providers. And it's an issue right now, especially here, local real estate investors thinking they could just buy these properties. The realtors saying, oh, it's a qualified opportunity zone deal. Oh, this, that. So there are people that are doing that, and it is a challenge right now, and there needs to be better education with it. Unfortunately for us, I mean, we don't have the resources to educate all of them or even work with them on the smaller deals, but that is the goal. But that is going on right now, absolutely.
So I will channel my inner securities attorney, even though I'm not a securities attorney and I'm not giving legal advice, okay? And sir, I didn't pay you for this question, right? So tomorrow, Caliber's qualifying a Reg A plus public offering. It's called an online public offering, and it's the first time in the history of our company where someone who doesn't have $1 million net worth can invest in what we do. It's $2,000 minimum investment, and it'll be online. You'll see lots of stuff about it if you want to know more. It's not an opportunity zone fund, so they're not getting the tax benefit. They're actually investing in my business, in our operating company that is the manager of the opportunity zone funds. But it's the same vehicle we could use in the future to do a crowdsourced opportunity zone fund where you could put a minimum of $1,000 or $500 or something like that into an opportunity zone fund. The reason why that is probably not being done is because it's a highly complicated fund to manage and it's very expensive. And so if you add all these things together, there's not a real good fit. There is securities law that exists in Arizona where you can do something called an intrastate crowd-funded offering and raise about $2 million plus or minus, where you could say, okay, everybody in the community is going to put $5,000 in this deal out of a gain. We can raise up to $2 million and we can buy this building together. There's no restriction in the opportunity zone law that says it's only for high net worth individuals. It's just that the fund itself is a security, and the securities law in our country is generally designed to make sure that someone who doesn't have $1 million net worth or fits that high net worth requirement can't lose money in what they call a risky or speculative investment. Now, I frankly think buying a building in your own neighborhood might be less speculative than buying derivatives on the foreign exchange market, but that's a different debate for a different day.
So along those lines, we're working in the healthcare example, specifically in rural health, on that model. It's complex, as Chris said, and it's not just gain, it's basis too, right? We have different vehicles, and you guys, I'm sure, spent the afternoon on rules and regulations for the types of investment. So what I will say is that it's a challenge, but just like we're working with the physician group who will actually be the employees of the hospital, we're working with the community to allow them to invest in it, right? Who's going to be the patients, right? Why shouldn't they benefit from the returns that generates in the community? So we're working very hard to structure it. We're also working very hard with our lawyers to make sure we stay compliant. But that is the spirit of that investment.
I'm not going to get into the expert's securities law because I think even as a non-lawyer, he did a very good job of talking about it. The one thing I would say is I wouldn't get caught up in the concept of opportunity zones in terms of people getting together and investing within whatever the rules are. There's a sort of a square peg round hole kind of thing related to that. If people want to invest in their communities, they shouldn't, the word opportunity can be kind of a red herring, opportunity zone red herring. There's other ways that people can invest and not focus on, it's got to be capital gains. Well, I don't have capital gains. I'm going to have to go sell my record collection or whatever. I think that is a little bit of noise. And I think the idea of people investing in their communities is bigger than the silo of just opportunity zone investing.
Do we have anybody else? Forgive me, I'm just going to move on.
I was just going to say real fast on that, Kendrick. You could actually see if there's a hero in the community who's done phenomenally well. And, so they kind of would bypass a lot of that, right? So there might be one individual that wants to come back into that community or have their footprint back into that community. And then those community members could actually drive everything through that individual. Obviously you'd have to go legal and stuff like that. But But I'm kind of seeing that out there in the city of Superior and some of the rural stuff, to do that hotel that I was talking about, we have to go to somebody who's done well in life to finance something that's out there.
I guess I'll just add, we actually will tell some of our rural folks is figure out who in your town is doing 1031 after 1031. Who's just rolling local real estate investment into local real estate investment because they understand the value prop of your community, Yes, sir.
Yeah, hi, thanks for hosting and appreciate the cookies and such. The question is in the for-profit world, in terms of understanding what debt pairs really well with the equity that's brought forward with Opportunity Zone. I'd love to learn in terms of your experience of either recourse, non-recourse, can you lock it in, how long can you lock it in knowing that you want to have this capital event to pay for it deferred? I just want to understand your experience with debt on the debt side. Appreciate that.
Sure. So we've financed quite a few properties. Our position on debt today is essentially we're actually more interested in floating rate debt that gives us the ability to sell throughout the life of the fund, because 10 years is a really hard time to look forward and understand what 10 years is going to look like. I'm pretty sure in 2009, none of us thought Donald Trump was going to be president in 2019. I mean, like him or love him or whatever, but at the end of the day, it's very hard to predict 10 years in front of you. So we're looking at floating rate debt that we can pay off and sell and exit and change, or we're looking at debt that is paired towards a refinance, typically in the 6th or 7th year, because that's when our investors are required to pay their taxes. And so we're using very little debt on our fund. We want to actually bring the loan to value up to about 50% when we hit that 6th, 7th year. And then we're going to distribute the proceeds of that debt to the investors so they can pay their taxes, because theoretically they can't sell their position until 3 years later. So there's a mismatch between those two things. So that's how we look at debt. Flexibility over long-term fixed rate or locked-in terms. And for us, being a fund, multi-asset fund with hundreds of investors, et cetera, we're not doing personal recourse. It's just not feasible. So anybody who's in the banking world, if you haven't already figured it out, you need to be able to do non-recourse financing at 50% loan to value or 60% loan to value or whatever your underwriting is.
I agree. I think that we're looking at it less in terms of pairing or matching in terms of the timeline of when the investors are going to make their capital gains investment and when it's right for the asset to refinance. And we're not dealing with as many investors. So the timing of the matching of, if we give them their money back in year 3 and they pay the taxes in year 6, that's okay. They've gotten their money back. We think our investors look at it more, when I pay my taxes, have I gotten money back enough from this deal to pay them? But they have the cash, these people, but they just like to look at it at least on an investment standing on its own. And then we're really, I think the one thing we are doing differently is probably a little bit lower leverage. So the odds that when you refinance, you are giving them some additional proceeds is higher than in a typical deal, so that you're answering that fundamental question of, am I getting enough proceeds out of this deal by the time I need to pay my taxes?
So we're trying to align it with a deferral on the duration of the debt. The one thing that we're challenged with is in the example where you've got, an asset that has both a development element and an existing business is a collateralization. If your land is part of your collateral and you want to develop that, you're looking at some challenging situations right there from a banking perspective. We have, truth be told, we have done our best to leverage our banking relationships in sort of that initial debt, and we have heard all the right things. Ask me when when we actually go to develop it. But that cross-collateralization issue is something that's real and that you have to be mindful of.
I literally just repeat everything that everybody said. If you're going to layer in any new markets tax credits, it's at the end of year 7, early year 8 is that you want to kind of flush the system and do a refi at that point. But everything else I've heard is what I'm modeling in what we're doing.
Can I ask, do we have any other questions? Yes, sir. Oh, yes. I mean, these are, no charge open events. So, we let them know. I'm sorry? Anybody who's asked to be notified is, and we certainly make sure the people who, did the opportunity zones, we talk with a lot of cities. So a lot of them are on our list. Some, I think it's got to be pretty close to everybody because we invited everybody to the first one we did 2 years ago when this happened. And unless somebody asks to be taken off the list, we don't take them off. We do try to make sure people know. And I would also say some of the law firms in town host sessions that are open. There's quite a bit that goes on. The League of Cities had an event last summer. Some of the CDFI groups, CDFA, for example, does some. So there's quite a lot of groups that city and county folks would belong to that are also doing their own training that's really targeted on that role. We did a webinar a few months ago that was really targeted on economic developers on how to close a deal, how to get beyond somebody having initial interest and close it. And we had both urban and rural economic developers speaking on that. So we do try to make sure that we have some targeted events for them.
We, as a private business, go out and present to economic development groups anytime they want us to. So we've done that with Mesa and many other places. Having said that, we've been saying the same thing for almost the entire duration that we've had our fund open, which is because we have a 10-year outlook and because we have flexible longer-term capital, we're willing to make larger lease incentives out and essentially say a tenant typically would get $300,000 from the lease incentive to open a restaurant, and they need $800,000 to open their restaurant. So if they don't have $500,000, they can't open their restaurant. Well, we might write a check for like $700,000 to open that restaurant. We've been saying that for a year and a half, and I had a conversation with an economic development person that's probably heard that at least 10 times, and that was the first time they heard it. So no matter what, you got to continue to say the same thing kind of over and over again and repeat because everybody's busy. Everybody's got a million things going on in their lives. And so that's why we just continue to go out and repeat the same types of presentations over and over again.
So you're not going to run into a lot of city council members or planning commissioners at these events typically, but to everybody else's point, economic development is generally the place to go. If generally, some cities view economic development better than others or differently than others, but the economic developers in our experience are the ones that are sort of charged with educating the commissions and the council specifically on some of what we talked about today.
And I will say we also travel. I was in Flagstaff on Tuesday. I've been to Benson. I've been kind of up and down. And one of our folks who work in rural will also carry the message quite a bit because they are literally on the road all the time. So they will also present on it and take questions on it. So we do try to, sometimes we go to them rather than having them come to us. But obviously there's one of me and I can't be on the road all the time. But we do have a rural staff that does a lot of that across the state.
And they could, and then I was just going to throw into, Lisa and I are on the road a lot out to the rural areas. And a lot of times, to start with, we just listen to them and what they think their vision is first. And so we can really talk to them about the initiative in of itself rather than just kind of blasting them with a ton of information. And so our team's kind of found that to be very useful, actually, is to let them kind of talk first and what they envision, their community and what they want within their opportunity zones. And then we try to, answer those questions specifically.
ACA has done a great job at Caliber and CPLC. And just really quickly, a lot of these rural communities, they truly don't believe that it's really an incentive for them because they just don't, it's hard for them to imagine that investments go there. So one thing that we try to do is just inspire them. I mean, it's less about education, more about, hey, this exists. Can you or your community think of creative ways to take advantage of it? And we're open for business to help you out. So that's, and a lot of council members are open. I mean, I was just over at the State of the State at Coach East College, and opportunity zones was the talk, and they're getting excited about it. They have 4 opportunity zones in that area. So just creativity, it goes a long way.
Thank you all for being here. Let's thank our panel. And again, take a cookie on your way out, meet the panel. Please make sure you have signed in. Thank you.